right now I'm just focused on getting the deal closed. It's only so much of the actual.
Hi.
Tice already at work. Love it.
Hey, Jesse, what is the dress code for the call? Should I wear a jacket?
It's 97 degrees in Boston, Jaime. So
Here too. Yeah.
yeah,
No, I'm asking about myself. Like,
yeah. No, you look good.
yeah.
You look good.
Okay.
No, it's a summer conference. Thank God.
Okay. Fantastic. Yeah.
We'll give people a couple minutes to come in, but this is going to be quite the day. Very excited for these panelists, and we'll have some great breakout rooms too today. So we'll be doing. Let me check what time that will be at, but yeah, yeah, 12 p.m. to 12:30 p.m. breakout room today with the group on, which will be great. We'll give people another minute or two, and then we'll kick things off.
Good morning.
Good morning.
Otherwise, you want to use Canva, doesn't look professional.
Okay, we're gonna kick things off right now. So appreciate all of you joining today. We've got a couple hundred people registered for this event. Today we're kicking off with real estate. Tomorrow will be venture and some angel speaking as well. My name is Jesse Wachowski, founder of DFX, Deal Flow Exchange. This is a community that we launched last year with a platform involved. It's basically a tech-enabled global capital network. It's taken off very quickly because we've just brought in some amazing people into the ecosystem. What we're looking to do is make it very economical and viable for everybody in the industry to easily raise capital. And the way we do that is a real focus on relationship building, connecting, and putting the right people in the right room together. So today, the people you're going to hear from, all of these people are involved or associated with DFX in some capacity in one way or another. Some of them are capital providers on the platform, some of them are raising, some of them are ambassadors. The people involved today, these are global real estate absolute experts. So we have some of these are top fund managers. There's a couple family offices that'll be speaking today. Thank you. And if everybody could mute their video right now, that would help. And we're going to actually give a couple of other pointers for this. So the reason why we wanted to do this in a Zoom format and not a webinar format is that this way you can all see each other, you can all connect. You can connect ahead of time before the breakout portion of this. So at noon today, 12 to 12:30, we'll be doing 2 breakout rooms. You'll be able to network with those on this call. We have a very formatted kind of breakout room structure. So we'll be talking through that when the time is of 12 p.m. So what I want to just kind of run through today is best practices leading up to this kickoff, which is at 10:30, but then also some things on how we structure relationship building within the DFX ecosystem. So from here, as far as breakout rooms, if none of you have been a part of a breakout room before, this is a way for the audience to divide into multiple groups. In this case, we're going to do 2 groups. I will head up one. Jaime Luck will head up the other. Jaime will be the one moderating this first panel in about 25 minutes. He is a professor of real estate at ESCP Business School. I'll give a little bit more of a background as we get closer to that panel, but phenomenal person, somebody that all of you in the real estate space should be interested in connecting with. He is certainly a great asset to the DFX ecosystem, has made a lot of amazing things happen for us. And then myself, of course, founder of DFX. We also have Ella Cook on the call. She is the COO, and some of the rest of the team, which you'll probably hear from at some point. What I also recommend doing is in the section in the top right of your screen, you'll see view settings, Zoom change. Click on that, click view, and click multi-speaker. This will help for the panelist portion. So what this does, it's a new feature and essentially blends the Zoom webinar functionality with the gallery. So you're going to see everybody still, but then the speakers will be highlighted at the top of the Zoom screen. It'll just be easier for all of you to basically follow along and know who's speaking, because right now we probably have a pretty good amount of people already on this call. In terms of how we're going to connect and run this. So would love for people to get involved in the chat box. The chat boxes on the Zoom calls that we run at DFX, they're always very alive. There's a lot of connections being made. There's a lot of referrals being made. So put in, who are you? Where do you live? What do you do? That kind of thing. Put in your LinkedIn. Just drop that in the chat, and that way everybody can connect, and certainly save the chat after the call, and that way you can follow up with people as well. We're also going to be posting a post on social media that can be shared. If somebody on our team can drop that in the chat, that would be great. This is something for all of you to interact with, and it'll help the speakers, the moderators, to also use this to bring up topics during the call. This is a great way for us as an ecosystem to be spread quickly. Definitely helps. So the DFX ecosystem, just for those of you who don't know, and none of this over the next 2 days is anything from a sales perspective. I certainly want this all to be as constructive, educational, and valuable for everybody as possible. And that basically explains what DFX is. So this is a global capital network where we don't charge transactional fees. We have a very simple, low monthly membership model. And the idea there is that the bigger this network gets, the better it is. Think of LinkedIn. Thank you. Think of LinkedIn when LinkedIn had 100 people to 1,000 to 100,000 to 1,000,000 to 100,000,000, right? The bigger this network gets, the better. And we're building a second version of our platform that essentially will be the LinkedIn of private capital. It's much more private capital focused. It'll make your lives so much easier to do business and to find the right people. That's releasing in October. I'm sure we'll highlight some things at some point during today and tomorrow in that. But overall, our 1.0 version of the platform functions very well. If you're raising capital, if you're deploying capital, would love to have you involved. Would love to have you involved in our networking calls. We have a real estate pitch event coming up, which we'll highlight. I believe that's July 24th. Deals on the platform get exposed to some of the capital providers on the platform on those calls. Those have had a lot of success. Jaime, who is moderating today, will actually be the one leading that pitch event. So certainly would love to have some of the people on this call involved in that. And now for the next couple minutes, I just want to talk about why we exist. And that is something that's very simple. All of you are in the private capital ecosystem. I'm sure all of you have seen how challenging it is to raise capital and how challenging it is to find the right opportunities. Right now, there's a real issue with capital providers being inundated with opportunities from all over, just being emailed into their inbox, and they can't find exactly what they want to deploy capital to. And then on the other side, if you're raising capital, it is a numbers game. You're reaching out to as many investors as possible. So there's just massive bottlenecks in the space. And then there's a lot of people in the middle that are charging 3 to 10% of raises or very high retainers or both, right? And what DFX is built to do is make it so that those raising capital can easily get their deal listed. The capital providers can filter by their investment thesis and find all the deals that match what they're actually looking for. Now, in this 2.0 version, the investors will be able to upload their investment thesis, and they'll aggregate all of the deals that match so that instant connections can be made and you can actually be speaking to the right person as fast as possible. Now, all of this is only doable if we're able to hit this critical mass of usership. And if you have been following along our journey, we launched last March. We've grown leaps and bounds. We have thousands of people involved. We have some significant capital providers. There's a $50 million equity deal getting done right now. All sorts of things going on the platform and in the community. And I want to just express that this is much, much more than a platform. It is a community. It is a network. The platform is just one piece of the puzzle. And what private capital really comes down to, if you are raising or really deploying capital, it's all about relationships. And in today's call, in tomorrow's call, this will be a theme time and time again, is the value of building relationships, how to build relationships, where to go to do so, all of that, right? Because at the end of the day, in real estate, you have similar deal structures across the board, right? If I'm investing in a multifamily complex, I can find another multifamily complex with pretty similar return profiles, right? And I can probably find dozens. So what really matters is the ability to build the relationship with the capital provider. Now, we'll talk a little bit about doing that on both calls, this call with the real estate and tomorrow with the venture side. The venture side, we'll be talking more about building relationships with VCs and angels. But right now, I just want to talk a little bit about family offices, because family offices are such a buzzword these days. And there's a lot of misconceptions about how to raise from family offices and the appropriate approach to do so. And I think that just highlighting how to have those conversations and what to do is going to be valuable for those who are looking to do so on this call. And you'll hear from family offices on this call, and you'll get a good sense of some of the things that I'm about to mention. So family offices, a couple things. One, the buzzword factor of it. So a lot of people say that they have a family office. A family office itself, defined, would be a family that is paying people to manage their money, their estate, their legacy planning, all of that. From a size perspective, single family office typically is considered 100 million or more of deployable assets, essentially. But really, these days it can vary in size for sure. But to have a quote unquote family office, it means that you're employing people. So when you're meeting people at conferences and they're saying they're a family office, you can ask questions for sure and get to the root of it, because a lot of people these days, you see on LinkedIn, you search and you see thousands of family offices. In reality, there's not that many, but there are a lot out there, and there are phenomenal partners in a lot of different capacities for capital. So a family office being somebody that's employing somebody means that if you're meeting somebody at a conference and they are the family office, that should make you think a little bit about it and just do your research on them, right? Everything is Googleable these days. But if it's somebody who is representing a family, that is likely a bona fide family office. It's kind of a quick little sniff test you can do in terms of communicating. Now, family offices, every single family office is different from another one. So when people make blanket references across the board about them, it's just something to think about and consider, because you'll meet a family office that's a fifth generation real estate mogul and they've grown through commercial real estate in the United States. You'll meet one that is a first generation tech founder who exited, right? And everything in between. You'll meet one that goes back centuries and is connected to European governments. Now, each one of these, when you're speaking with them, it's a different conversation. And some of the best things you can do for yourself are ask them questions about the family, ask them questions about how they've generated the wealth, ask them questions about where they come from, what their goals are, what moves the needle for them. These are things that will give you so much more value than you going in and talking about what you're raising capital for. Because quite frankly, I've seen, and part of the DFX ecosystem is built the way it's built so that the capital providers are not being solicited all day, every day, because people are just throwing deals at capital providers, especially family offices, and it's not what anybody wants in that position. And you have to put yourself in their shoes, right? If you're sitting in this position where everybody wants your capital, but you're actually probably a huge value add in a lot of strategic ways, you would rather them understand you. So this is part of why we are built how we are, is that instead of the deals soliciting the capital providers, we want the capital providers to sit back and think, okay, I can add value to this company. I want to invest. I'm interested in learning more about investing in this company because I see what they're doing and I see how I can add value, right? Because that is so much more than dollars. You can get dollars anywhere, but strategic capital is what really moves the needle for companies. It's what really moves the needle for investors as well. So with that being said, find out exactly what helps these family offices. These days, a lot of that actually comes down to legacy planning, passing off to the next generation, things like that. And if you can add value to these groups, then they will take your call, then they will take your meeting. They're happy that they family offices do a lot of business. They do a lot of co-investing. They have typically great networks. But if you go in and you just pitch them, trust me, they've heard a pitch very similar to yours a dozen times over the last 2 weeks. Especially when we're talking real estate. Real estate is such a similar space when you're going project to project. Yeah, your project might be amazing. There are other amazing projects. So it's about building relationships. I'm going to say the same thing tomorrow for the angel and VC section, because quite frankly, there are thousands and thousands of companies raising capital, and plenty of them think that their deal is so much more special than others. And what it comes down to is actually people. It's not the project. It's not the company that is, pre-seed raising capital. It's the people that are running that. And a lot of that comes down to how do you build relationships, right? If you can build relationships with somebody, then you can build relationships with other people. So this is the biggest component to what makes DFX unique is our focus on community building, our focus on relationships, our focus on paying it forward and trying to add everybody who's in the ecosystem, give them as much value as possible, knowing that it creates an environment where deals can get done. It creates an environment where all of you can succeed and generate just as much value as possible for everyone involved. And that's where we're at as a company is really looking to provide this value, growing exponentially because we are providing this value. And I encourage everybody on this call who hasn't attended one of our networking calls. Of course, we have a little bit of networking built into this event, but our networking power hours right now we're hosting every other week. This past one, we had 120 people on. There were a lot of family offices, a lot of VCs, a lot of angels, and a lot of great investment sponsors, a lot of great founders. And we split the room into 2 breakout rooms. So there's about 60 people on the real estate side, 60 people on the VC side. And it is an extremely powerful hour of networking where it's very structured. You get to say who you are, what your company is, what you're looking for a referral. Could be capital, could be service providers, could be clients, and then what you can provide the network. And then everybody goes into the chat box and they're just linking you up with other people. This has been amazingly valuable for so many people. We do these for free. Definitely just register, use this, kind of QR code, register for our platform. You can sign up for free. We'll be dropping some also free trials if you want to get a paid version and list an opportunity or deploy capital on the platform. But sign up and then join these calls. We also have a global connections call. So those are people who are typically high level, maybe CEO or family offices or whatnot that are doing business globally. Certainly jump on those calls if that fits kind of what you do. If you're also into early stage investing or anything like that, tomorrow's event is phenomenal, similar to this one in terms of the quality of the panelists and moderators. Great group tomorrow. A lot of great VCs on that call, a lot of great angels, some family offices. Certainly would say attend that one as well. And give us as much feedback as possible for these events. We'll be doing more of these events in the future. The more we learn from you and what helps you, what moves the needle for you, the more we can support, right? And that's everything we're trying to do is how can we support you and help you as much as possible in a way that saves you essentially 99% of what you would pay somewhere else? Because at the end of the day, it's a community. The way we look at it is everybody on this call is one referral or one relationship away from success. And that is the message that we want to spread, because the more that this community gets involved, the more that we all try to help each other, the more that that's going to happen, the more that success breeds success, and we just continue to spread. So, when we launched last March, we had no deals really live on the platform. Now we have over 600 deals live. Again, thousands of people involved, hundreds of family offices involved, and we're just spreading at a speed that is quite incredible to be a part of. And I appreciate everybody on this call taking the time out of your day. I know we're all very, very busy. This is going to be an immensely valuable couple of hours. Tomorrow will be too. Anything that you do within our ecosystem, we are going to support you to the fullest capacity. We have an amazing internal team. All of them are extremely capable. We have a very horizontal corporate structure. So you can ask anybody anything at any time, and they'll be able to support you and help you or point you in the right direction. And if you want to get more involved in DFX for more than just a user, we do have a very important call coming up on Friday. I can't give too much of details on that, but if you want, you can reach out to Ella. Ella will drop her email in the chat. And I would say send her an email and ask what I mean by this, because we have a really important call Friday that is very, very interesting for those who want to be more involved in our ecosystem. That's about all I can say with the rules and regulations these days. And that's another thing on our platform. We don't take a fee, meaning we do not need to register as a broker dealer. We are a community, global community that allows people to function, meet through the platform, take the deal off the platform. I want to really highlight that because that is something that makes us very different as well. It allows us to keep our cost low. Obviously, you want to KYC the other side. You want to go through the whole process of doing your due diligence. We do a level of due diligence on deals coming in, of course. We're making sure they're a real person, real company, real opportunity. But we're not here to say if it's a great deal or a bad deal. That is for the marketplace, that's for the community to decide in terms of engaging with the deals. With that being said, in 2.0, the deals that are getting more attention and attraction, they're going to be pushed up in the deal feed a little bit. And then also in 2.0, you'll have a lot more analytics as to what types of profiles are viewing your deal and things like that. So 2.0 is 100 times better than what I built and released in March of last year. But what I did build and release has been very successful for a lot of groups. So certainly use it. In October, they'll have a new and improved version that is just going to be incredible. One of the key features I'm most excited about is you'll be able to zoom in, geolocation, see everybody on the platform who is in your area. You can zoom in to say a 1/4 mile radius, and then you'll be able to, if they have open profiles where if they're open to messaging, you can message them, meet up with them, whatnot. You'll be able to set travel mode. So you're going to a conference, set your travel mode ahead of time. You'll be able to see everybody who's going to be at that conference, everybody who's going to be around that conference, set up meetings around it. All of this is going to just change how private capital functions, moves, relationship building. You'll be able to find the right people so much faster with this 2.0 version we're launching later this year. So, huge developments on that. We were just doing some of the review this morning. It just looks phenomenal. The UX UI is beautiful. And so that's really where I want to kind of leave this, is a lot of exciting things happening within the DFX ecosystem. It's free to get involved in the DFX ecosystem. I know that most of the people on this call already are, which love to see. But if you aren't yet involved, get involved. All we're trying to do is make your life easier, provide you as much value as possible. I'm sure that all of those who are involved on this call will vouch for that, because that is exactly what we've done for the last year in 2 or 3 months. And now we're going to do it at a much faster capacity, much better capacity moving forward, because we have so much exciting events and things coming up within the DFX ecosystem. We partner with a lot of groups. So if you are part of if you lead an investment network, or if you are involved in one and can introduce us to people, would love to speak with them. Like them very well. And then other than that, just give us feedback. The more feedback we get, the more concrete kind of ideas, advice we get, we can implement quickly and we can provide further value. So feel free to send us any of us messages, put things in the chat, whatever it is. Love to hear from all of you. Love to listen to our community and make sure that what we provide is 100% what it needs to be for all of you to thrive. And with that long monologue, I'm sorry if that was a little bit too long. We're gonna get to kind of next steps. So this will kick off at 10:30. I just want to say a little bit of a word on Jaime Luck, who has been an incredible piece of the puzzle of DFX. And when I say the puzzle of DFX, our goal is to get every deal centralized into one location so that the investors globally and the lenders globally can easily find exactly what they want to see, right? And to do that right, we need to bring on the right people within the ecosystem that are really looking to pay it forward, because at the end of the day, our entire mission is to help as many people as possible in the private capital space. And those who pay it forward are the only ones who really can support that, because that is our mission, is to pay it forward, right? When we help people, it turns out that's a great business model, and a lot of people help us and introduce us to different areas. So we need people who really want that, grasp that, understand that, and we'll push for them. And Jaime has been amazing. He's a professor of real estate at ESCP Business School. It's a top 5 business school in Europe. They have multiple campuses across the continent. Also, he sits on the PropTech Innovation Board for the government of Monaco. Just an amazing person, and has really opened up a lot of different doors for DFX and really paid it forward himself. And we cannot be any more thrilled to have him as a leader in our ecosystem in the European real estate side. I'm going to turn this over to Jaime right now. We also have Dino, Lewis, and Bryce speaking, but I'll let Jaime introduce them. And look forward to this really amazing panel.
Thank you so much, Jesse. My first words are just to say that I really admire all you have built. Yeah, this is the a real disruption to the capital markets. And I wish you all the success. I'm really happy to be part of this. And and the topic today, it's an amazing topic. It's a topic I love. It's initially the day one conference. It's on global capital, the future of global capital in real estate, real assets. And today my session, it's on traditional versus alternative ways to raise capital. So the idea was to bring like 3 experts that are doing investments in real estate in different part of the world that kind of represent like those like traditional versus alternative ways to invest. All of them are like super advanced and they have great visions. So I'm gonna introduce our 3 speakers very briefly because I want to then ask them to say more about what they do, and then we kick off with questions. So we first have Luis Arauna from Arcano. Arcano, it's a very well-known European fund with headquarters in Spain. And Luis is Chief Investment Officer in real estate at Arcano, based in Madrid, Spain. We also have Brice van der Boot, who is founder and CEO of Realis. Brice is based in France, the south of France. And Realis, as you will hear, it's an amazing new enterprise that is very much into the tokenization of real estate. We're going to learn a lot about what he's doing right now because I think this is kind of the future. And then Dino Ansoulis is the main director of Ricus Capital. He's originally from the United States, but he works in the Middle East, so he's super well connected. And we are going to learn a lot about how basically he's able to communicate with US investors and attract capital to the Middle East and what type of real estate investments he's involved. I think it's a worldwide vision of how real estate is transforming itself with the new technology. So I'm really excited about this call. Let's start with Luis. I can see many people here. So Luis, can you tell us a little bit about Arcano? And it has a lot of history, tradition, and recently internationalization. So what type of investments you do today, and what is the history of Arcano?
Yeah, thank you, Jaime. Thank you, Jesse. It's a pleasure to be here with all of you. So my name is Luis Arauna. I'm the Director of Acquisitions at Arcano Real Estate. Arcano is a global financial services company with headquarters in Madrid, but offices all over the world. In the US, we have New York, LA, and a few other smaller ones. And in Europe, we have about 10 offices all around Europe. We started off as an advisory company, so we did M&A. Arcano was founded in 2003 by Álvaro de Remedios, who was at the time the MD for Deutsche M&A in Spain. and he decided to just do it differently and try to get into the alternative asset management and investment banking just in a different way. So he started Arcano just as an advisory firm, and now it's grown to like 300 people more or less. Half of that is in the M&A department, and the other half is in the asset management department. So M&A, I think Arcano is the firm that does the most deals in Spain year over year. Of course, in terms of volume, Goldman Sachs of the world beat us. But in terms of number of deals, Arcana is always at the top. The other half is asset management, and that's where I'm at. And I lead the acquisitions team for the real estate department. Other than real estate, we got private equity, venture capital, infrastructure, debt. We got a few different funds for credit, and then aviation. And then there's also research. Arcana research is also very well known. We have a very top, well-known economist, Ignacio de la Torre, and he's always on the TV and everything. So those will be the three arms. And in terms of myself, so I started off I studied in Madrid, engineering, and then I went to the US for 5 years, then London for 3, and then I'm back in my country, like I said, always doing real estate.
Yeah, truly international. Breeze, another great speaker we're going to have today. Can you tell us a little bit about Release in terms of capital raising, how your new technology is disrupting the market?
Yeah, so sorry for the noise around them. I'm in Monaco today at a big TradeFi event, and we're gonna speak there. Yeah, it's a very nice place to be and very international, a bit like in this panel. I mean, it's even more international in this panel with more specialists. So I'm glad, Jaime, you can organize that and to bridge really the different forces. So what we are doing is we are bridging the traditional financing world with the digital innovation to bring it to the DeFi world. That means we structure the investment vehicle in Luxembourg. We tokenize them to be able to distribute it at the same time to traditional investors, like most of you in the room, on a normal bond subscription with rising costs. But we also enable the opportunity to go toward the DeFi world. So that's the thing on tokenization. Just for the people who are not too familiar with that, it's a strange word, but it's very, very simple. Just imagine it's the shares of a company which are put not only on the registry at your lawyer or notary, but on the blockchain. And thanks to that, you can do a lot of different things and opportunities. So to link it towards the real estate world and to give you a bit of background how we came there, I come from real estate investment. So I like to build things. But like most of the people, you build a small one, then you want a bigger one and a bigger one and a bigger one. But the resources are not unlimited. So we had to find ways to attract and to structure club deals in a more efficient way. So that's how we came to that idea, say, okay, blockchain is really helpful in that sense, so that it's transparent, clear, and can enable us to onboard more investors on one hand, but also to structure products in a better way. So that's really what we are building, and that's the thing, that we work together, Jaime, also on different parts, on projects in Spain or in other places, and that's where the ethics is very interesting in connecting all the dots and people, where you have a backbone which is transparent and easier. Because today, you can invest in many products, you have many opportunities, but to make it easy, cross-border, it's very, very difficult. And so that's what we're building with the blockchain together.
Yeah, thank you, Brice. Really exciting. I have lots of questions for you. And the third speaker is Dino. Dino has an amazing background back in the US and now in Middle East. So please tell us a little bit about what you do, and I would like to know like how your background helped you like growing in a different geographical area like the Middle East.
Sure. Thanks, Jaime. Thanks, Jesse. Look forward to the conference and getting to know you guys. So I'm Dino Antulis. I founded Reckless Capital about 10 years ago as a advisory business based in Dubai, focusing on helping some family offices here with their global real estate, cross-border real estate strategies, and also do some strategic advisory for some large US-based fund managers and asset managers that focus on real estate that look to predominantly raise capital from the Middle East, where I'm based, but also these days looking at investments in the Middle East, which is an interesting new topic coming. My background, I got into real estate a while ago. My dad was in construction and worked for Turner Construction in the US, but he traveled all over the world. So I was raised in Europe, Middle East, Asia, US, even though I'm from New York originally. And through that kind of, growing up in that background, I managed to meet some very interesting people around the world, grew a very big network. So naturally kind of fit into this cross-border global world of investment and advisory. And once you have the bug of living overseas, it's very hard to stop. So I think I've lived in 8 or 9 different countries and like 12 different cities, but now have a family and we love living in Dubai. So we're based there and that's where we conduct our business right now.
Yeah, well, thank you, Dino. Okay, so we are going to start with our panel. I want to have kind of the first set of questions about what we understand by the traditional approach. And given that Luis is working maybe in the most traditional type of investment fund among the three of you, I would like to get him first and explain us how Arcano has been raising capital historically and any change that you guys are doing right now. And I'm also interested in understanding whether you are seeing like competition from small and medium-sized investors with all this technological revolution that we are living today.
Yeah, sure. So you're absolutely right. Arcano is a traditional asset manager, an advisory firm. We, as I was saying, we were started by the MD of Deutsche. So he obviously leveraged all his contacts when he started in 2003. That was good times, obviously, in Spain. But then came the bad times, and we struggled through. And now we're here, right? So obviously the most important thing in terms of capital raising is always the context. That's why DFX is so important and so relevant nowadays, because there's a misconnection, I think, between capital providers and capital people looking to raise capital nowadays, because there's so much capital out there, but everybody's struggling to raise capital. So the way we've done in the past, obviously at the beginning, leverage all those contacts, and now we virtually have all the family offices, Spanish family office and Portuguese family offices, behind Arcano in some way. So you can name any family office, and I'm sure they invest in Arcano in some way, either in private equity, venture, aviation, or they just hire us for the advisory role in an M&A deal. We obviously also have a lot of corporates behind us. And I would say Arcano is, one of the most known names in Spain. However, that was also a problem when you start to get bigger and bigger, and now with 12 billion under management, it's you need to start looking outside of Spain or outside of the Iberian Peninsula. So that's what we've been doing in the last few years. We've been trying to go international and find capital outside of our country. But yeah, I mean, all the family offices, endowments, all those from Spain have been working with us and helping us from behind forever. now we also see also a shift in the discretion that they want. So now, and then I'm sure everybody else is seeing the same, but now traditional LPs are not that they became more professionalized and institutionalized, if you will. So they now have more people, they have younger people, they have analysts. So now they're not just capital allocators, they want to get skin in the game. So they're looking for co-investments, right? And I believe everybody else is because I've talked to so many of them, they're seeing the same thing. So
that's actually, Luis, the co-investment part is I'm really interested, and we are gonna get back to that. So before we go to what is kind of maybe happening today, I'm interested in learning from Dino, what has been the traditional kind of type of investments or kind of priority for US investors, and how do you see them kind of change their attitude towards international investments?
Yeah, well, I mean, for US investors, I mean, based in the Middle East, in the past, that market, the GCC in particular, has not been one that was big enough, had been advanced enough, the capital markets. There was a lot of things that just stopped US investment into this region, right? And US investors, I mean, the US market is one of the biggest in the world, or the biggest in the world, obviously. So they started there. A lot of them moved into Europe, a lot of them moved into Asia, but limited access to the Middle East. In the last couple of years, and that's what I've been focusing on, there's been a shift, right? There's so much capital in this region. There's so many large players that raise capital from this region. And 10 years ago, 15 years ago, people would come here with a suitcase and leave full and then say, thank you very much, parachute in, parachute out. As Lewis was saying, from all levels, from the sovereigns to the pension funds down to the family offices, everyone, especially in this region, has become more institutionalized. And now they're saying, okay, well, if we're going to give you so much capital, what can you give back? How can you share some of your expertise, some of your insights, bring some of your capital here to the region? So there has been a push from the LP side here actually to bring capital to this region. And it worked initially. And it was kind of something that people were doing because they were so large and they had buckets of capital. But now the region has grown so much. There's been so much growth. And with that follows, the need for real estate and asset classes where now you're seeing the big names all coming in. I mean, Brookfield was here, and Apollo came in, and KKR is here, and Blackstone is looking, and name after name after name. So from US investor perspective, I'm seeing a big shift in them being open to investing in commercial real estate asset classes here in the region, which is an interesting twist that has happened more recently.
Thank you, Dino. Great. So let's start maybe going towards more alternative. And I think, Breeze, this is kind of your territory. You are really disrupting the market in terms of entering the market for kind of structuring deals using tokens. So first thing I want you is to explain to the audience what a token is, how you use a token in real estate, and then maybe how you can make traditional investors and kind of crypto investors live together in the same capital structure.
Yeah, that's very interesting what Dino and Luis shared, because actually we are at the same time disruptive, but also helping traditional institutions to provide what the LPs are looking for. Because yes, people want to have alternative. Some would like to invest in token because it's trendy. Some would like to invest in crypto. Some would like to do a diversification of the portfolio. But talking about the tokens, you have a lot of ways. You have some stories, and good and bad. On our side, we are on the regulated part. So we issue security tokens, which are the representation of the ownership of companies. So basically saying if you want to link it to a traditional world that people understand, it's a stock market for not listed companies. And that's what we are enabling. And when Luis said to convince or to raise more capital, you need to have something different, right? You want to have some appealing assets or commercial assets. Sometimes you need to have huge tickets. And that's really where, with the tokenization, we have a good advantage because the blockchain enables a lot of existing things in the traditional world, which are too costly, so which are not set into place. Therefore, with automatization, transparency, and technology, the cost to put everything in place are a lot cheaper than a traditional world. That means today, because it's not even anymore tomorrow, it's today. And even yesterday, we started already. Family offices, through their traditional asset manager, can have access to such kind of diversification. But the tokenization is just in the background. So that's really where the people should not be afraid. It's regulated, it's clear, and then you can move forward.
Yeah. Great. Like before, like going to a different section, I would like to ask Luis whether like traditional investment funds like yours see tokenization like a threat or like complementary to what you guys are doing. Are you ready to enter in this space?
I mean, it would definitely be a threat if you don't move fast enough, right? But if you're willing to, modernize your way of raising capital, then it's definitely complementary. I've been investigating tokenization since 2018 when I was in London. I'm not saying I was the first that looking at this because this is obviously much older, but not a lot of people were looking into that in real assets back then. And I feel like that there was this company in London, for example, that were tokenizing skyscrapers in New York, right? And they went bust, not because of that, but because they didn't know exactly how to do it, right? And how difficult that could have been. It's been 8 years since then almost, and now we are doing it much better. I think it's definitely something that we need to keep an eye on, that we need to integrate into our capital raising. The most difficult obstacle is going to be, like Bryce is obviously saying, convincing traditional managers to raise capital that way, right? Because and don't get me wrong, there's a lot of regulation, there's a lot of KYC that needs to be done, and I feel like the ones that get us all that done to investment managers are the ones who are going to get the trophy, because if we need to go in, you provide me the platform, but I need to do basically all the regulations and the legal stuff, it's not worth my time, right? Probably. But if you give me a very robust platform that has everything done, and that what we need, right? That you've talked to us before building all these, then it's extremely relevant and extremely important, and it will be more in the future.
And getting back to Bruce, just to kind of close like this topic, can you put together like traditional investors with, say, crypto investors for the same deal? So think about like a skyscraper in New York, and you get money from both sides. Is it possible using tokenization?
So I will not take the example of a skyscraper. I will take the example of something we are currently structuring, which is the data center.
I will be asking you about the data center later. So, but just in case,
So let's take the case of the skyscraper. So you need to raise capital and to enable people to invest. It's the same thing as people investing in euro, US, or pounds. They can also invest into crypto. So it's not a problem at all. What Luis mentioned is when you have a structure which is regulated, you have a KYC, so you onboard the investor. If you, Jaime, would like to invest in that skyscraper in US, for me, as the structuring person, I will say, okay, is it in my legal documents, Jaime, is he allowed to invest directly into the skyscraper? If yes, no problem. Then he's sending the investment. This investment, is it coming in fiat? If it's coming in crypto? If it's coming in crypto, we can do on ramp or front. It's very, very simple. So it's not the crypto, it's just another way, another payment method. It's the same thing, like you accept Visa, Master, or Amex. Similar.
Right. That's very cool. Let's move to another like block of questions, which is more about geographical shifts and or cross-border trends. And I have a question for Dino, that given that he has all this international experience, US versus Middle East, and I'm wondering like whether like traditional oil money from the Middle East is now competing with US investors, and whether you have some kind of asset classes in the real estate space that are kind of reserved for them. So how competitive is the Middle East in terms of investments?
I guess I would say, again, 10, 15 years ago, deals would find their way to the Middle East probably at the end of the chain last, right? So it wouldn't be the greatest deals. It would deals that couldn't happen or couldn't be done by US capital. So they were trying to find cheaper sources of capital to complete those transactions. That was when, you know, the world was different, right? And there was capital from all over the place, widely available, cheaply. Fast forward to today, you know, the Middle East has been one of the only places open for business to raise capital in the entire world. So with that kind of vacuum of capital from the rest of the world, the Middle East now is seeing deals first, right? So they're getting to see interesting deals, they're getting to participate. And during this institutionalization process of all of them, they're also getting part of the platforms. They're getting opcos and propcos. They're getting less fees. They're working together to leverage kind of the capital they have to get really good opportunities. So on that front, it's definitely less competitive. They're more active than most people, and they're getting fantastic opportunities and deals that they've never seen before. And then as far as asset classes, you know, traditionally, most people around the world love to put money into shiny office towers, right? It was easy to deploy a lot of capital. It was pretty secure. And then you had, you know, COVID, and then, you know, you have the rise of AI and the credit markets. So obviously that went away. Retail was also interesting. But what's really interesting now to everyone is the living sector. So multifamily is always hot, single family homes for rent, SFR. Student, although they're watching it carefully with all the political situation going on. Senior. So under the living umbrella, there's quite a few sectors that they are looking for. And then data centers, of course, with the rise of AI, digital infrastructure is huge. It's just very difficult to find good valuations. Those are the only ones that kind of held up during this last crisis. So industrial's also been something that's been hot. Again, with the tariffs and stuff, people are cautious. But you know, in the future, everyone believes that living industrial data centers, the fundamentals are very, very solid.
Yeah, super interesting. And Breeze, now that we are talking about cross-border investments, I assume that in your world, like where you tokenize, there might be some regulatory kind of constraints. I'm wondering like how this affects your business. So just give an example, maybe like you get investors from one country and investments is in a different country.
The regulatory part is a key component, because you have two components. You have one from the financial part, where we are in Europe, it's under the MiFID regulation, meaning I can tell you, okay, we are in Luxembourg, you're a citizen of Europe, you are an accredited investor, I can tell you, Jaime, this investment is great. You should invest in that. That's one part of the regulation, traditional one. Now we are going towards the tokenization. That means you will not buy a stock, you will buy a tokenized stock or a tokenized bond. But actually it's a token which is on the blockchain. And this in Europe is under the MiCA regulation. So it's another regulation, another set of licenses. That means to be able for you to buy that token, you will need to buy through a company which is regulated on that. So that's within the EU. So it's already small cross borders. Now, when we want to go to the US, need to comply with the SEC regulation and the MENA regulation. That means 2 companies need to be present to be able to do the deal. We need to have one in Europe and one in US. Then the KYC, all the compliance have to match so that the transaction can be possible. So if you think about the technology, it can be done within seconds. But when you think about the regulation on the top of it, it's like Luis said, it's been few years that we are all working on that. The technology today is there, but the regulation need to adapt, or the technology need to adapt to the regulation. So it's still challenging to do the cross-border part.
That's great. Now, in terms of investments, like what is really attracting capital and what is new? Like Luis, you were before talking about like co-investments, and I understand that like the traditional investments is kind of different. So can you explain a little bit like what is happening now? Because I can see that co-investments where the LPs deciding is really disrupting the market. So what is your experience in that respect?
Yeah, no, absolutely. That's something that's been happening in the recent years, and we saw that maybe 2 3 years ago, maybe during COVID times, maybe because of COVID, I'm not so sure. But at Arcano, our core engine keeps being the commingled discretionary funds. That's obviously where we feel more comfortable. That's the most agile way of deploying capital. And especially when you are value added like we are, and you're looking for those high returns to cover our expensive cost of capital, then you need that flexibility, and you need because some deals, off market deals, are very time sensitive. So that will continue to be our core, and we'll try to get as many funds as possible through that, and we're still doing it. We got 30 funds open at the moment, and we keep seeing that need from some institutional capital. However, like we're all saying here, the co-investments seem to be the way to go now, and we've been doing a lot of road shows in the US and in Europe, and all the traditional LPs they now have a specific team that only do co-investments, and the reasons are obvious, right? They want to have skin in the game. They want to have discretion over what do you invest and what do you not invest. And we want to be able to provide those LPs or those teams to also invest with us. So at Arcano, the good thing is we're very flexible. In some other funds that I've worked in are definitely not allowing any of that yet. But at Arcano, we've opened co-investment vehicles to be built in Spain, and we're currently, for example, starting one that are going to have 20 different LPs. And they're all going to co-invest, and then our fund will co-invest in a minority stake, right? But at the end of the day, we will continue to be the GP and the manager of those deals. So they'll have discretion, obviously, to go in or out, but we need to have some kind of structure. Otherwise, it's just going to be a mess, right? Obviously, there's an issue about governance and alignment of interest. But as long as you have trust in those LPs and they have trust in you, and to be honest, 95% of those investors have already invested in us in some other way, so the trustworthiness is there, then it's fine, because then we all play with the same rules. And I think that this has also opened the playground to other maybe startups or smaller companies that are competing with us in the same deals. And before, we were able to get those deals beforehand because we had the capital. Now it looks like everybody's fine with giving you exclusivity without having capital, because they know that there's so much money out there looking for co-investments that they'll raise it right away. So we definitely see a trend in that direction.
Thank you, Luis. Getting back to Dino, that he was explaining how based somehow like why US investors and other types of investors go to the Middle East. I'm wondering, like, what is their perception of using like new instruments like tokenization on the one hand, so that we can somehow relate to what Brice was doing, and also whether US investors kind of invest in the Middle East, they want to do deal by deal, or they are happy to enter in a investment fund that they have some kind of open horizon.
Yeah, the market here or in the Middle East is still kind of in its infancy. So there's a lot of family offices or government entities that do most of the developments and stuff like that. So there's very limited fund format kind of options for investors to come in. So what I'm seeing is mostly on a deal by deal basis where they won't come in alone. They'll look for a JV partner or a local sponsor that can help them kind of navigate and source land and source debt, et cetera. So that's on a deal by deal basis for the people coming here first, and to kind of build relationships, learn how things go, and then maybe together with them they could create a fund and raise capital, external capital to grow bigger things. On the tech side, I mean the beautiful thing of Dubai is, I mean they're ahead of the curve on most things, and tech included, and they're big in blockchain, they're big in AI, the UAE in general, and because it's kind of a blank slate, right? There hasn't been the markets here were always dominated by just groups internally. Now it's kind of opening up, but they don't have to go the traditional methods. So I think the Dubai government just did a tokenization, one of their first. It was very small. It was like I don't know, 1 bedroom apartment, but sold out in like 5 minutes, right? And they're planning to have, I think, 5-10% of real estate all tokenized in the next 10 years or so. So tech, it's very important, the tech aspect, to democratize and kind of minimize that check, and Dubai is kind of running away with that to try and get a global lead, and they've got all their regulations in check, from what I understand. And then platforms like DFX, I mean, the dream of a lot of allocators and investors is to have platforms that can enable them to easily find stuff that fits their criteria without having to use intermediaries and just go through all the traditional hoops. So I wouldn't be surprised if what you guys are working on takes off pretty big in this part of the world, because that's what people are looking for.
Yeah, well, thank you. And actually, I feel the same way. Like, it's like a dream becoming true that connects the effects, connecting all the ecosystem worldwide. And you never know if your investor is going to be in the United States, but the deal is in the Middle East, and this is happening through technology. This is amazing. Thank you, Dino. And Brice, you mentioned an investment in data centers that you are now tokenizing. I know about it because we have talked before, and I think it's really exciting. I would like you to share like some details that with the audience.
So we were, because there is a lot of noise around tokenization, real estate. What happened in Dubai recently, for example, it's another way of doing it. But to make the things understandable was for the data center. What is a data center? It's a storage with computers. So that's very simple. So you have a warehouse where in the audience, we have a lot of people from real estate. It's very simple. You build walls, so you have a valuation. Because the valuation is the land plus the building. So that's one set. Then you have what is inside. Inside, the case that we are discussing is we have several. One is AI data center. So working with the latest NVIDIA new chipsets. So those are attracting a lot of clients which are in the needs of using AI agents, or any AI company wants to have an space and usage of that data center. Therefore, on an investment perspective, you have an investment that you can value because you have real estate. You have business cash flow coming in, so you can value it. So on a traditional valuation perspective, it's valuable. So it costs that much money. Going back to what Luis said, where people want to have co-investment, skin in the game, it's very attractive to many people to have investment into that project. So we discussed with a lot of family offices, but we have one large investment bank who is going to invest 100 million into that data center. Why? It's because it's very structured and very clean. And you would tell me, okay, what's the point of tokenizing it? Then you have one investor, it's perfect. No need for the fundraising. What is very important to keep in mind is the tokenization is not there only for the fundraising. It's there for the secondary market. So if today, as a bank, I put 100 million euro in a data center, which is giving me 13% yearly, I want to stay like that. It's very simple, but let's assume that tomorrow you have another opportunity. It would be very interesting to put on the secondary market those tokenized shares. And on that secondary market, talking about regulation, you can go through MiFID companies and have access to retail investors. So you can distribute very easily and gain some liquidity. So it's really that part of the tokenization which becomes very attractive. And the data center use case where for me speaks even to retail investors is because wherever you go, you have AI written somewhere. And the people, they don't understand that when they type a message on their phone, it's using AI, but it's starting to kick in. So they say, okay, you can invest in an AI. Okay, good. I will put my money. So yeah, tokenization this way is really helping.
No, it's amazing. I love this duality between primary and secondary market. It's worked out very well for debt. For instance, like using debt in the primary market, a mortgage debt in real estate, and then banks are gonna securitize that, create a mortgage-backed security and sell that. They slice and sell all over the world. So you are doing that with equity, which it's fascinating. So we have just 2-4 minutes, and I would love to hear from Dino and from Luis what they think the future is bringing us, the near future in terms of real estate. Dino, maybe we start with you.
Yeah, I mean, if I, had a lot of money to invest, I think I would go long on data centers and the living sector. Yeah, definitely. And if the yields are what Brice is saying, then I think there'd be a lot of interest from this part of the world. But yeah, look, with the way tech is going and where AI is going, it's hard to argue against the demand for digital infrastructure and data centers globally, like anywhere in the world. And living sector as well. I mean, there's a shortage of housing in most places in the world.
Yeah.
And that needs to be addressed. And as the world kind of absorbs what's happening with AI, I think there's going to be a lot more kind of personally, remote work and things like that, which will increase kind of where the living sector goes and getting more innovative on that side. So, and then industrial as well, I think is interesting. I struggle with where office is going and other sectors, but yeah, those are the kind of sectors that I like, and I'm seeing a lot of people's interest and the capital flowing as well.
Yeah. Thank you, Dino. Luis, your last couple of minutes, like trends or the future.
Yeah, no, same. Obviously, living is extremely important, and especially in some countries where there's a big imbalance between supply and demand. Definitely Spain is one of those. I'm a little biased also in terms of going into the hospitality sector because of how important it is in Spain. So we're definitely seeing a lot of activity in hospitality in Spain. Especially in the islands, we've been seeing a lot of transactions lately, and it's as hot as it can get right now. So we're definitely active there. And then in logistics, I've done a lot of logistics in Europe. I've seen better days for sure. But Dean is right. There's absolutely a huge future there. And the problem with logistics, the way I see it, is the yields compressed and the capex went up substantially during the 2022, 2023 area. era, but now they're coming back to stabilization. So even though it's been a tough year, I would say, at least in Europe, in last year in logistics and industrials, I think it will be a very good year this year and definitely more in the future. And of course, data center, we've done data centers. We did a 70 megawatts data center just last year, and we're definitely very active in the sector. I'm not gonna bore you with the macroeconomics of that because we all know it, but that will definitely have a very bright future.
Wow. Well, many thanks to all of you. We are gonna start with the Q&A. But again, thank you. It was an amazing conversation, and I'm very happy about how it went. Before the Q&A, let me do a small break because I'm organizing a DFX real estate pitch tank in a month on July 24th. It's gonna be European. And I think it's an amazing idea, like to get capital seekers, in this case, real estate developers or real estate sponsors of a deal, presenting a deal to investors and then having investors giving feedback, asking questions. So we already have secured like 2 great capital providers, one from the United Kingdom, the other one from Spain. And we have a call for potential sponsors that would like to present. We have already a couple of them kind of with great deals that we are really considering, but maybe Kat or others here in the call may want to share the QR so that any of you want to be considered for the European real estate pitch tank at DFX. So, well, let's move towards the Q&A. Kat, I think I leave the word to you.
Yes, so we had a few questions around education and where people can find more information on tokenization, as well as understanding the basic concept. So you guys have been in this space for so long. Is there any top 3 tips or places where our students on the call can learn more?
Let me take it on that one. So for the tokenization, it's a broad topic because that word can mean a lot of things. We were talking about data center, for example, and AI. AI is using token as well. Today, if you have ChatGPT, you will pay the credit of token. It's called tokenization. It's not involving the blockchain. And then there is tokenization on the blockchain, which is the fact to transferring, in our case, share of a company in the blockchain. But tokenization can be also in different parts of the world, utility tokens, or even towards NFTs. So what I would say is, particularly for the students, don't stop at the first comments and the different parts, and don't take my words for what I say, because our view on the tokenization is really regulated. So I would say it's very restrictive towards what we can do because of the regulation. You have a lot of other opportunities. So the best thing is to read, obviously, from the largest media. I will not mention the names here, but yeah, do some researches and comparison, because today, particularly in the student world, and because we go to a lot of conferences where we have always very, very similar question. Can I do that? The technology is there, but then it depends where you live, where you stay, what is your nationality. So you have all of that together. So I would say to understand tokenization, first you need to understand a bit the technology of blockchain, how the blockchain is writing. So it is written, sorry. So you need to study cryptography, but also on the legal part. So I would start from the basis and then move towards that.
Thank you so much. The next question that we have is, does the EU recognize a token as a legal ownership claim on real estate? This person might have missed this, but if somebody can jump in.
I will answer again. So it depends again, what is your token? If the token, as a French citizen, I have my house. Today, my house is not tokenized and it's under my own name, so I cannot hold anything. If tomorrow my house is held by a company, so in France it has to be a SPV, and if those shares of the companies are tokenized, yes, a token will represent a part of the ownership. And recently, a sales was done this way. So it's not a problem at all. It's recognized.
Great, thank you. I don't know if anybody has any other questions. Let me just check the chat. Okay, so we have one for Dino specifically, mentioning offices in the Middle East. Are they also investing there, or are they investing elsewhere? So country, regions, and I guess general information.
Regarding the office sector, I guess.
Yes.
Well, before I was mentioning it's hard to get my head around investing in office. I think that, getting into more detail would be more in the rest of the world at the moment. The Middle East, I think Dubai is one of the best performing office markets in the world right now. Super undersupplied. People go to the office, they go to work 5 days, 5 days a week. I mean, the remote, it's very different. I think the further east you go in the world, the more people utilize office space. Even in Asia, homes are so expensive, right? So it's not the most comfortable thing to work from home. So you'll see a lot more work in the office place. So going east, I think the office sector is an interesting asset class where people are making money. And here, people I was involved in an office transaction here recently, actually, from a Hong Kong-based investor that came in here. So I think office here is very interesting and exciting, and undersupplied. But in the US and Europe, very little interest. I mean, there's a handful of families I know, or institutional groups that would consider something that, is in the middle of central London that's yielding a very high yield, that they can just get really good quality, well-located real estate. Same in Manhattan, potentially. I know the office market is coming back a little bit, but the capital from here is not focused on that from my perspective.
Great, thanks. We had one private question actually directed towards me. With DFX and a platform like ours, how do you see the international community connecting? Maybe what trends are you all seeing? What sort of events, conferences are really laying eyes within the international community, and also the US, right? Because I feel like there's a disconnect and a gap. And so this question, any of you can take this.
I mean, it's interesting from the Middle East perspective. Trying to source deals was always a challenge, because it's so far away, and the biggest market in the world is the US. And so we would attend many big real estate conferences across the US, go monthly, to meet with developers, owners, operators, brokers, just to get deal flow. But today, because of the reasons I mentioned before, where there's not that much capital in the world, everyone's coming here. So people are coming here, managers are coming here, everyone's coming here. So there's a lot less travel, to physical kind of events, right? I think a lot of them are joining some of these digital virtual kind of events, just because it's quicker and easier. But from what I see, it's kind of following where the money is. Then it's easy, and right now we're in a period where it's easy to access and meet different people and find opportunities because they're coming to your doorstep. But when things turn again, we need platforms like yours and others to kind of make it easier.
Great,
Yeah,
thank you.
I can just add, I absolutely agree with Dino. We say no to deals every day, 10 to 12 a day. It's crazy how many deals we get into our inbox every day. And that's been the norm for all the investment managers that I've worked in. However, the fundraising part is been tricky everywhere I've been, and I've been at bigger and smaller funds. It's always been tricky. So the democratization of that fundraising is extremely important, and that's what Briz and others are doing extremely well. But then there's the misconnection between the capital and the deals. It's amazing what Dino just said, right? That there was a time where there was people in the Middle East, family office and whatnot, trying to get deals and they couldn't find them, right? That's incredible that's happening, and I'm sure it still happens, and that's where DFX and this platform comes into place, right? I'm sure there's a lot of work to be done in the future, but bringing everybody together is what needs to happen for sure.
Great, thank you so much. I don't know if Jaime, you have anything else so we can wrap up?
No, I don't have anything else. I just want to say thank you to the speakers for your time. It was fantastic, great panel. Thank you, Kat, for the Q&A, and Jesse for introduction. And just a few words very quick. Financial Times has just published a couple of articles about how broken capital markets are in Europe. Has been like lots of debate about that recently, and I think the effects it's really stepping in, and we will see it growing very much. So, well, thank you, Jesse, for everything, and I think we are gonna go to breakout rooms, right?
Well, yeah, we will. I want to highlight a couple things. I want to first thank Jaime, thank Bryce, Luis. That was a phenomenally educational panel. I cannot wait to see what our marketing department does with all of this new content because, as you know, we are a content machine out there, and that helps get the engine really roaring. And this was as good of a panel that I've seen in years. So really appreciate the participation of you four. That was just incredible. For those who are out there who are not on DFX yet, again, it's free to sign up, but if you have a deal, I saw a lot of deals being listed in the chat. You can list it for the capital providers on the platform right now. So you can use promo code SUMMIT if you're not on the platform yet. You'll get a free month of DFX. Average cost of our platform is $39 a month, and we don't charge any transactional fees. So it's already extremely well priced, but I would say test it out and then join the networking events, join the global events, everything else, and just derive as much value as possible out of this ecosystem. That is our goal for you. From the breakout room side, we'll cover this in a second. What I want to do real quick is just highlight a little bit of 2.0 and what's coming out, because I talked about that earlier and had a couple of requests to just cover a couple of things. So for those of you who don't know a bit about myself, founded the company and built the 1.0 version that's live right now. You can go to joindfx.com. It'll pull up, and you can take a look at all the deals that we have on the platform and sign up. But since I released that and was an army of one, now we have an army of 100 plus internally and thousands of people out there that are champions of us, pushing us out because of what we're doing. So I wanted to highlight some of the things that I talked about in that 2.0 feature, because this will release later this year and it's going to be incredibly impactful for all of you. So the platform itself is getting certainly quite the facelift. The workflow in terms of signing up is just going to be something like this. Let me just get through, and I want to talk a little bit about the community side of things. So first, you have this whole section of your dashboard. You're going to have latest feed from your community. This will be basically all sorts of information. For instance, I'm in Boston, so I'd be part of this Boston Founders Group. And these communities, what we're looking to do, you'll still be able to see all of the deals on the platform, search all the deals on the platform, but we also want a lot of people to contribute to their local ecosystems. As many of you are aware, most of the investing, not only in real estate, but also in venture and everything else, happens within a geographical range of, say, 30 miles from your house. I mean, people are much more active within their local communities, and we want to encourage that, right? So this is a way to see all of the deals in the different areas. If I click explore here, this is what the world is going to look like more or less. You'll be able to zoom in, click on different deals, things like that. If I click here, it'll zoom in here. So when you zoom into the map, you'll be able to see the locations of the deals. And then there's also going to be a feed over here of the individuals within this space. You won't know the individual's exact location, but you'll know they're in this space. You'll be able to click in on them, message them if they have an open profile, and be able to do a lot of other things in terms of interaction. So this type of platform does not exist yet. Some of the features and functionalities we're building in, we're also building in things to increase the credibility so you can build relationships faster, so you'll understand somebody's background faster, the deals they've done, things like that. Everything we're building into this is to make it easier for you to build the right relationships faster. And those start with your local area, but then obviously we have this global approach and we want people to meet globally as well. So just a lot of exciting pieces of the puzzle that are coming up there. Now, if I come back to the presentation, is everybody seeing this event best practices screen? Yeah, okay, perfect. We're going to be going into networking breakout rooms. Now, Jaime is going to host one. I'm going to host the other. These are a great way to ask questions, but more so to network with one another. So Jaime will be leading the charge in his. That'll be a very global real estate focus. I would say anybody in that space definitely join on his side. Mine will be more, more or less capital raising side, but on both of them, it's going to be the same workflow. So this will be more of a networking power hour, but Jaime and I are here to answer questions on both sides. The context of this, each person will be able to say who they are, their company, what would be good from a referral standpoint or what they're working on right now, and then what they can actually provide to the network. Now, this is similar to our power hours. We're going to keep it to 1 minute per person as close as possible because we got a good amount of people on this call. And then those who are on the call, if you could go into the chat, try to connect them with the right people from your network, they'll do the same for you. So these types of events, they have significant ROI for everybody. Love to see all the connections that are made. And then we will return to this main room. We'll do a little debriefing on this networking event. And then we'll have about 15 minutes to have lunch and take a little breather, and we'll start the next panel after. So that's this next setup, and looking forward to having you all join in this networking session. So Thais will kick off the breakout rooms, and then we'll get right into it.
Hey, Jesse, I just wanted to notify you that it's going to be Ari and you leading those rooms. So just FYI.
So in case any of you has questions, we open the rooms. You can manually assign yourself and just let me know in case you have questions.
Thais, where do we go to do that? Because last time I wasn't able, you had to place me in the real estate room.
Yeah, I think, can you see my screen now? Or, yeah.
Yes.
Yep.
So it's on
Yes,
this.
so go ahead. So you can click on breakout rooms on the bottom of your Zoom. So you can find Jesse and Ari's Zoom, and you can select the one you'd like to go.
And
hi.
between them again?
Breakout rooms on the bottom of your Zoom page, and then click there. Or maybe it's going to be in your 3 dots more in your Zoom bottom, and then just choose the room you would like to be in.
Oh, okay.
What's the difference between them?
One is leading by Jesse and focus more on the US side, and the other one's going to be leading by Ari and Jaime, more towards Europe
Oh, great.
real estate.
Okay, yeah, on my phone, it's actually in the top left. It says join breakout room, and there's like a thing.
Yeah, for anyone that's confused and on a phone, it is on the top left.
You can also let me know in case you to need some assistance to get into the rooms, and then I can manually assign yourself.
Hey, Thais, I think whoever's left in the chat, go ahead and split them up evenly between the rooms. I think there's like 7 or 8 people left on here. You can just assign them.
Hopefully that networking session was valuable for everybody. We'll resume from the lunch break at about 12:25. We'll go over the next panelist. Chris Meyer will be the one moderating this next section. Many of you probably know him already. I'll be introducing him again, but he is the founder and president of a group called CCC, Contractors, Closers, and Connections. It's a 50,000 person real estate network in the United States. And he is a partner of DFX. I'll go into a little bit more details on everything, but this is going to be a great panel. He's brought on some great speakers as well. So looking forward to that hour. We did have about 100 people participating earlier, so hopefully people come back into this room. But even if it's a lower head count on the second session, there'll be a lot of great material for us to share within the ecosystem as well. So really appreciate everybody staying on. This is going to be a very impactful hour. This next call, some of the biggest real estate players in New York on this next call, Family Offices, a couple others. So really would recommend staying on and listening in. But again, appreciate all of you, and we will restart in about 10 minutes.
Jesse, you look hungry too. You should probably take a lunch break too.
I actually just scarfed down some food. I'm on a very interesting kind of eating regimen. So I had my meal, and I'm all right. I might get some more coffee though. Coffee is
there you go.
Yeah,
There you go.
yeah, that is something that I think I will do. But yeah. It's funny, last year I ran this event, and this was when we were really early on with DFX, and ended up it was mostly me doing everything because we were a much smaller team. So I ended up having to run it from 8 a.m. to 6 p.m. because it was a longer event, and didn't give myself a lunch break. And it was it was all in one day. It's nice that this is 2 days. It's nice that we have significant support and much better people involved than just myself. So last year, yeah, it was a grueling day, and thankfully this year is much different. I was able to turn my camera off, get some coffee, get some snacks during the last panel. So very much appreciate it.
That's a lesson I learned when I went to college, was to schedule myself a lunch break.
Yeah, exactly.
You know, first you pack in all your classes, and then all of a sudden you realize, wait a minute, I don't have a lunch break in there.
Yeah, that's literally what happened last year on this. So, again, we have a lot of help now and a lot of great people doing great things in the ecosystem and in our marketing team and everything else. So, fortunately, it wasn't that bad. Tomorrow won't be bad either. I'm moderating one of the panels. Ella's actually going to moderate the other one. Tomorrow's is VC focused, but there's going to be a lot of interesting conversations going on. So certainly encourage everybody to attend that as well. And there'll be in that one, there's a couple VCs, a couple family offices speaking. And it'll be similar setup, 2 panels, I believe a similar networking kind of time frame, and should provide a lot of great insights. The VCs that are speaking, there's some premier ones that are participating, so really excited to hear what they share.
Well, in the way of an unsolicited testimonial, I was contacted yesterday by someone who saw my deal out on DFX. It didn't turn out to be a fit, but we had the conversation, and so that's just kind of a plug for DFX and people putting their deals out there, because I did get investor who reached out to me, and like I said, we had our conversation, and it wasn't a good fit, and that's fine. But it was first off, it was great practice for me giving my pitch, but it was also good. Then I did expand in my network here, and they were interested as individuals, but it wasn't a fit with their particular company. So I thought, just in a way of an unsolicited testimonial for DFX and your deal platform.
Yeah, I love that. And that's what we want to encourage. So most people, when you get something funded, 9 times out of 10, it's going to come from somebody you've known for a bit of time. It's very rare that somebody sees a deal and invests in a deal, and we have seen it happen. Certainly happens, from time to time, but everything is relationship based. Everything is about building that trust and that reputation with the capital provider. So these kinds of conversations, that's exactly what we want to hear, because right now you aren't collaborating, but maybe in a year, 2 years, 3 years, you will, right? And now you're in the same network, and you've talked, you can talk again. A lot of times, even if the capital provider sees your deal and says, yeah, that's something that I would do, if they're just meeting you for the first time, they might sit and watch and might participate in a later round, or might see something else that you do in the future and invest. And so it's all about just kind of planting those seeds, building those relationships, and paying it forward. And the more you can help them with what they're looking for, on those conversations, turn it back around and find exactly what they're looking for, and think about who you might be able to connect them that they can help, right? And in that case, that's how you build relationships really in the space, is connecting the right people together faster. I mean, it just makes the whole relationship space a lot easier. If you can provide value to the capital provider, they'll look at your deals much more favorably. So just kind of a little bit of advice on that. And the DFX ecosystem, that's exactly what we do. That's what we're looking to do. So those who are participating in this community, it's very much a give first, kind of pay it forward group. We have this global network that continues to grow, and the idea there is that because of our economics being so viable for everybody, and not charging transactional fees, and hosting things like this, and doing other high value impact work, basically this community grows every single day. We get more deals, we get more capital providers, we get more service providers coming into this ecosystem every day, which means that today is the worst day for DFX. Tomorrow is going to be better. The next day is going to be better. The next day is going to be better. It's a snowball kind of business model. So anybody who hasn't signed up yet, I mean, I would say join. There's no reason not to. And tomorrow we're going to add more value to your business. The next day more. The next day more. And then if you like that business model, and you want to learn more about that business model, again, there's this particular call on this coming Friday, and you can reach out to Ella at dealfluxchange.com. It's dealflow, no E before the X, change.com. You could also reach out to me, same type of email. And we have an important call on Friday, so would love to have people on that see this business model and appreciate it. All right, Thais, you can pull this screen down. Chris, nice to have you on.
Young man, it's a pleasure to be here.
Excellent, excellent. We had about 100 people earlier, and then we had the lunch break, so I'm hoping that a bunch of them return. But either way, we have this all recorded, and we'll push it out accordingly.
So was that a real estate centric
Yeah,
group?
yeah,
Okay.
yeah. It was it was kind of global real estate. So Jaime, who you might have met from the DFX ecosystem, he's kind of building out our whole European side. He moderated it, and then there's speakers from a couple areas, mostly in Europe and Dubai. And it was very interesting, very high quality information. So it's recorded. We'll put some stuff out.
Yeah, that'll be great.
Yeah.
Sorry that Laurent can't join us, but we'll just be hopping between Michael, Jay, Alex, and I've heard Alex speak at some summits. It's been really great. So I think each of these guys are going to play well into each other.
Yep. Excellent. Excellent. That is good. I'm looking forward to it. We'll kind of formally announce in a couple of minutes. Yeah, overall things are good. How's things in Atlanta?
It's hot.
Hot here too. 97 degrees up here in Boston.
Yeah, it's going to be at least 90 something, but the heat index, I mean, you just step outside and you're just drenched, and I already run hot. And then so tomorrow we'll be heading to Nashville for our second event of the year, two of four. We host quarterly events in Nashville, and it's looking really good. Really great guest list, and it's only going to get better throughout the year. We have some really good venues, private clubs, and then the end of the year we're going to John Bon Jovi's private club off of Broadway, and we have Bob Knackle coming in and Kyle Matthews speaking, and like we got this country artist giving away guitars. It's going to be really neat.
Love it, love it.
That's one you should put on your calendar too, aside from obviously the Boston, but 11/20 in November, it's going to be a big day for the Nashville audience.
I would love to be in Nashville on 11/20. That sounds like a lovely place to be that day. So you can count me in on that. I'll be there.
Yeah.
Yeah, send me the information. I'll put it on my calendar. I would love to. I've actually never been to Nashville. And yeah, I'm a country music.
It's a lot of fun. There's just a lot going on, and it hasn't stopped for 10 or 15 years. I mean, so when we finally got the team together and it was the right team to launch Nashville, we haven't had a down day. We had the amenity of going to the largest log home mansion in the United States, which was country singer Barbara Mandrell's old place, and it's called the Fontanelle. And we launched there. It had been closed for something like 5 years, and they just reopened it. And we brought everybody in. We had to take shuttle buses to get everybody up there, so it was a really cool destination spot.
Love that. Love that. That sounds good. Yeah, I mean, we have a couple of minutes, so if you could highlight, how many chapters is CCC up to, and just kind of an overview.
18. We have sort of a dormant chapter of Phoenix that we've been speaking to 2 people about, sort of taking the keys and running with that chapter, but everything else is going really well. So Boston's going to be incredible. New York's been doing great. I personally touch on Atlanta, New York, and Nashville. And I'll probably be taking over Greenville too, and maybe handing over the reins on Nashville more and more, so I can focus on Greenville. But yeah, everything's going really well.
Christopher, this is Tom Shepard. Forgive my ignorance. So what is it your team does?
Hey, Tom. Yeah, so we run a commercial real estate centric business networking platform across the US. So we have different chapters involving 5 buckets of individuals. We have real estate development, investment, anybody contributing to the capital stack. We have management professionals, asset management, portfolio management, things like that, brokerage. And lastly, we do offer a network of trusted contractors, whether they're attorneys, engineers, architects. So really, we embody the full spectrum of the commercial real estate life cycle. If things need funded, any of that stuff developed, we handle it all.
Awesome. Thank you.
So how does
Yeah,
a
sure.
how does a person become involved with you and your network?
So the best way would be to visit our website, which is just www.contractorsclosersconnections.com. We'll put that in the chat and just look and see what chapter is most local to you. So we have as far west as Phoenix, Dallas, Fort Worth. We just hosted a big industrial real estate summit in Dallas, and as far south as Miami, and as far north, which will be soon, Boston, that we're going to be working with Jesse and a couple other individuals, really powerhouse group of senior level commercial real estate executives in Boston. And we do some really great stuff in New York. We'll be hosting with Bank of New York Mellon end of the year in December in New York. So they vary on frequency. And like in Atlanta is our HQ. That's where I'm located, Atlanta, Georgia. And we host 8 events per year. Our current event right now is involving all of the development authorities across Georgia, all the municipalities that want to say, hey, we want more manufacturing or cold storage or hotels or office or what have you. So we bring together hundreds and hundreds of people to have those discussions in person, sort of get a state of the market, and in real time initiate some deals.
Excellent, excellent. Thank you, Chris. And I'll give a little background on our relationship. So, Chris has been, the CCC network has been one of our oldest and largest partnerships for DFX. So DFX was launched early last year. Very quickly, there's clearly great synergies in the 2 organizations. So CCC became a platform partner. We have a private label for them where it's all their users and deals. Great network. I've been to a handful of CCC events at this point in different areas in Atlanta, New York, and their events are some of the best real estate networking events I've been to in my life. Great quality of people, also a blast. A lot of times they have some sort of theme tied through them, and the atmosphere and the people who come out, it's a great time. So certainly recommend their events. As Chris mentioned, Boston, they'll be opening up in September. I'll be part of kind of building that out as well. So really excited to participate and pay it forward for everything that Chris has also done for DFX. And it's a great collaboration between the 2. Certainly just recommend getting, if you're in the real estate space in the United States, the CCC network likely has a chapter in your geographical neighborhood, and you should certainly think about being a part of it. With that being said, I am going to share the slides here, and I'll let Chris take over in terms of introducing himself a little more if he feels the need to, and then the other panelists who will be on this call.
Yeah, thank you, Jesse, and appreciate everybody who is joining us today. I think it just really embodies the need for the solution that DFX had brought to us, I would say over a year ago, this amazing partnership, because we host great in-person events, and then people would say, well, we've got this SPV, or we've got this fund or opportunity that requires financing, and we have M&A, we've got debt, we got this and that. And Jesse's forum and the whole DFX team has just been really hands-on with showcasing how people can get involved through events like this. They're hosting in-person events. They're bringing these family office networks and institutional capital partners together in such a way that really we had never seen before. So we think it's great. And we appreciate all the thought leadership that it's bringing together. We've made some great connections personally through it. So again, just thank you for joining us. And some of the people that you're going to meet today were hand selected by myself and the CCC team. And you're going to really love hearing from these guys, really great thought leaders in their space. Unfortunately, one of our keynote speakers for today, Laurent Gray, he might be listening. Some of his team might be listening today, but he caught fever just yesterday in his travels. So Laurent, take care of yourself. We're just going to be hearing from, 4 individuals today, myself moderating, Jay Patel, Alex Cartwright, Derek Barker, and Mr. Michael Bull. So without further ado, should we get started? Do we want to cover any housekeeping sort of rules as to how questions and things like that are going to be handled, Jesse?
Yeah. So put the questions in the chat. We'll have time at the end of this panel. I just want to make sure that everybody's here. I see Alex Cartwright, Jay. Are the other panelists on yet, is my question. Just want to double check that. I'm not sure if they are, but we can start with Alex and Jay and proceed. But yeah, throw the questions in the chat. There'll be time for Q&A, and we'll let Chris kick it off and introduce these two.
Yes. Can you guys send Michael Bull the link, please?
Yes, I'll resend it to him. No problem.
I
Okay.
have it.
Great. All right. We're all here. Thank you, guys. So for those of you who don't know, the CCC was founded back in 2019 in Atlanta, Georgia. We represent approximately 50,000 individuals across the United States. I believe about 10,000 in Atlanta alone. So please reach out to us so we could see you at our in-person events, virtual events like this. We have 5 verticals: real estate development, investment, management, brokerage, construction. So it's really hard to catch us with a curveball. We have professionals who can help you from the feasibility stages all the way to, getting financed and exploring different JV partnerships. There's a lot that we can do for you, and we just look forward to serving. We have a philanthropic element to what we have always done. So we go into local markets like Nashville, Atlanta, Greenville, and so on, and we typically donate to sex trafficking victims, homelessness, fentanyl awareness, natural disasters, just anything we find in the local community that we can give back to. We have a preset amount to which we're donating to those community pieces philanthropically. So thank you again for joining us. We're going to go ahead and get started with introductions to our first panelist, which is going to be Mr. Jay Patel of JMS Family Office. Jay, would you mind elaborating and expounding upon your background and expertise today for the panelists?
Sure. Jay Patel, based in Atlanta, Georgia, hotel developer and hotel distressed mortgage investor. Grew up here in Atlanta, Georgia, played on the under-17 U.S. soccer team in Sweden and Denmark, went to New York University for economics, then went to the London School of Economics. I worked at GE Capital in corporate finance, buying whole loans and securitizing those. And then I joined Goldman Sachs in New York in the principal finance group, essentially betting the bank's money. Worked on over 60 billion of transactions, leveraged buyouts, M&A, sold Hertz for Ford for 17 billion to the Carlyle Group and Clayton Dubilier Rice. Worked on the Mitsubishi bankruptcy. And yeah, we were buying whole loans with the bank's money, securitizing them, and then creating a derivative credit default swap. So if anybody's seen the movie The Big Short, that was my group at Goldman. I left in 2008, joined my family office. And yeah, so father's bought or built over 140 hotels over the past 40 years. We started 3 banks. We started a property casualty insurer and then a reinsurer captive in Bermuda. We bought a company from the Blackstone Group. We are a franchisor of 90 economy hotels. And I spend most of my time buying distressed debt from lenders, servicers, debt funds, first mortgage loans that are in default. and either try to restructure that debt through a forbearance agreement with the borrowers. Otherwise, we'll foreclose, take back the collateral, reflag it to a Marriott, Hilton, IHG, or a Hyatt product, exit through sale to a broker, or refinance non-recourse through the CMBS markets. And I'm building a couple of hotels right now, Candlewood Suites in Oakwood, Georgia. It'll be open in 60 days. 3 hotels in Winder, Georgia, Marriott Town Place Suites, a Hyatt Studio, and a Hilton Home 2. And we're doing a large $300 million mixed-use project in Duluth, Georgia. We sold 277 apartments to the Heineken beer family, Westplan, a retail developer. I'm doing a Marriott Autograph Hotel, Turkish Hammam Spa, speakeasy, cigar bar, Japanese Peruvian restaurant. We're also developing 83 townhomes and then a shipping container food truck plaza. Yep, that's it, Chris.
Thank you, Jay. He always gives the best intros. I actually saw your sign, I believe, at the Winder site recently, and Jay's also a scratch golfer. Thank you so much, Jay. We look forward to hearing your insights today. Alex Cartwright, Professor Cartwright with Hotel Shift. Would you mind giving us your professional background before we get started?
Sure thing. Thanks for the invite, everyone. Great to see you, Chris. I'm Alex Cartwright. I'm with the Patel Family Office. I'm chief economist based here in Dallas, Texas. We are a little over 400 hotels in 28 states. We're in a couple hundred other businesses, varying from life science to housing to kind of all kinds of things where we see value. I'm in charge of all things related to hotel acquisitions, and kind of my bread and butter, what I spend a lot of time doing is buying hotels that make sense for conversion to multifamily. Beyond that, I'm also chief economist for a new platform that's going live in Q3 called GreatX, where we are tokenizing real estate, starting with hotel assets. And I'm glad to talk about tokenization and how that unlocks liquidity. My background, as Chris alluded to, is as an academic economist. I spent 10 years as a tenured professor at a state school in Michigan, but always had my hand in real estate, whether that was buying multifamily or been a consultant for some large multifamily and mobile home groups, and decided to be in real estate full-time with the Patel Family Office. So pleasure to be with you all.
Pleasure, Alex. Thank you for joining us. Drop some items there in the chat if you have any of your conferences coming up or how people can contact you. Thank you so much. And let's introduce Mr. Michael Bull, CEO of Bull Realty, if you wouldn't mind.
Hello, everyone. Chris, everybody, thanks for having me. Appreciate it. To tell you who I am, I'm going to give a perspective. I think we have time on the market timing for acquisitions, and to tell you why I might know a little bit about that is, unlike Jay, which is super impressive, man. I love what you guys do, and 60 billion in transactions and stuff, and what you guys are doing, that development is just awesome there in Sugarloaf. So very impressive. But the reason that I have a good perspective is I stayed at a Holiday Inn Express last night. So I, but to tell you, I've been a broker, commercial real estate broker for 35 years. I just call it impolite company. I'm a licensed broker in all the Southeast states. I have owned Bull Realty, which we started 27 years ago. We have about 50 people, and we have groups in every specialty. So hotel, land, office, retail, industrial, multifamily, in pretty much every sector. I particularly work a lot in the REO world with lenders and borrowers. Also sell office buildings mainly around the Southeast. So that's kind of working well together right now. And then also I host America's Commercial Real Estate Show, which has been on air every week for 14 or 15 years now.
Wow.
And I get to interview some of the leading analysts and economists in the country. So I get to see their perspective, and then I get to see, our perspective as brokers. and then kind of the history of being in the business so long. So thank you. Glad to be with you.
Appreciate that, Michael. And lastly, we've got Derek Barker, and then we're going to get into some more deliberate questions. Derek Barker is the founder of Nectar.
Hi, Chris. And thanks for having me on here. And I was just able to get in after some technical difficulties. Give my quick background. I've been in the real estate business really since 2010. I started out, when I was a senior in college, buying single family assets. I worked at Goldman Sachs trading structured products for a while, but continued to build a portfolio while I was there. Ended up leaving. I had about 500 multifamily units down here in Atlanta, and built a business buying, renovating, and selling apartment complexes in the Southeast and Southern California. We did about 5,000 units. A lot of just real gut rehab type work, but then we ended up, recapping them, having a decent size, portfolio of stabilized assets. Started selling assets in about 2021 timeframe or 2020, and started Nectar really to provide capital to people with mid-market portfolios, so 100 million to a billion, or 100 million to $500 million kind of AUM portfolios, providing liquidity against their illiquid but low leverage cash flowing assets. And that's what Nectar. So that's what I do at Nectar. We've invested in just over 9,500 units in 31 states throughout the country. We've also done a good bit of self-storage and hotel and retail, but we're probably about 80% multifamily. And we have a fund, and we also have some in some of our larger investors in our fund. Also invest in co-investments, and we have some SPVs, aside. So we've raised money and done capital formation in every type of way that you can see over the past 15 or so years. We've been GPs, we've been LPs, we've been in the pref position, and now we're mostly in the pref position.
Thank you, Derek. And I just want to give a plug to Nectar. I would say that out of all my investments this year, our investments with the Nectar platform are outperforming anything else. So thank you guys for doing what you do. Let's keep generating those returns. So yeah, check out what Nectar is doing. And we're going to get into actually Michael Bull. Can you please provide us with a state of the market, current opportunities across commercial real estate asset classes, and lay the foundation for the rest of this conversation, if you wouldn't mind?
And you want this in how many minutes? So I know how to.
Can you do a 10 or 15 minute like we talked about?
Yeah, I can do 1 minute to 10 hours. So wherever you want.
Yeah. Let's start there. I know you're
Okay.
an expert in the office
Right.
sector, and we can circulate around and then hit on some more deliberate questions.
Sure. Well, I think the market's kind of interesting right now. If you look back at the last couple of years since interest rates started spiking, transaction volume went down about 50%, slowed down acquisitions and dispositions some. And then when the market started changing a little bit, when the Fed reduced the rate a little bit at the end of last year, then the elections business started picking up a little more transaction volume wise, and getting buyers and sellers together. And then after the presidential election, after the first year, it picked up some more. Then tariffs started happening, and that slowed down things a little bit more. But the market's performing well. Now we're seeing activity pick up more. Most property types are doing really well, except for office in some cases. Retail's performing well, generally, industrial, self-storage, hotels. Everything's really doing well. So it's unlike past downturns because performance is so good. We also have a lot of properties that have less leverage than they did last time. So there's different opportunities. One of the opportunities we see is considering acquisition timing. And it's been really interesting because if you look at what happened when interest rates started spiking, new starts stopped. Right? But new developments take a while to develop, as you developers on the call know. So those take a long time to develop, and a lot of those have delivered. And so the new deliveries are now starting to kind of roll off. If you take the multifamily sector, for example, in a lot of markets, we're headquartered in Atlanta, do a lot of business in the Southeast US. You saw rent increases kind of really high. And then when these new deliveries all hit, it started coming down to some cases level to some rent losses, rent growth losses. Well, now we're starting to see it pick back up. I think what the expectations are in a lot of the submarkets of around the US in the Southeast and a lot of the sectors is that we're going to see rents really increase, a lot of demand because of the lack of new construction. And why was there a lack of new construction? You all know the rapid rate increases in interest rates. You also had a spike in inflation and construction cost. You also had some construction items you couldn't pick up. So there's just been, if you want to look at one of the examples, look at the office sector around the US. 2025, there was an article in CNBC, I think CBRE was also involved, that suggested in 2025, there's going to be more office space demolished and converted to other uses than there is new supply. And I think that hasn't happened in 35 years. You're also seeing more demand come back to office from the back to office demands of a lot of these companies, a lot of the big companies, every month, every quarter, having more people come back. And we're also seeing, I think it was last 4 quarters, we've seen positive absorption. There's more tenant traffic. So if you're looking for opportunities, one of the opportunities I think there are is multifamily in markets where the new supply has just dwindled and the demand keeps increasing. I think we're going to see some rental increases in the next 1, 2 to 3 years. That's going to be, it's going to cause inflation, but if you own apartments, it's going to be great. If you look at the office market, I think that's a real contrarian investment right now. I think that demand there comes back sooner than we think. To give you some examples, we're taking out today 185,000 square foot, 7-story, beautiful office building in Durham that's going out at $63 a foot. The replacement cost, it's probably 10 times that. We're taking it out. It's only $12 million. It just appraised for $19 million. So there's some incredible opportunities. And you think about acquiring office properties at 10% of replacement costs, you're going to be at such a low basis that you can really compete. You can really out-compete anyone in the market. And a lot of these properties are being converted in other uses. And when you think about time, and I'll leave you with this, I did an interview with Gunnar Branson, and he is the CEO of AFIRE, an association of investors investing from around the world and in the US. And they do a survey, and you look at the difference between the survey last fall and the one they did early this year, the differences were remarkable. One of them was, how do you think commercial real estate is going to perform in the US in 2024 versus 2025? The more respondents said U.S. real estate's going to perform not near as well as it did the last year. So they're expecting poor performance. But when they ask them about the allocation of investing in the U.S., the increase, it really increased. So even though foreign investors are looking at, hey, the markets can perform worse, they want to allocate, they want to buy more. Think about that. Why is it? Is it because of the lack of new supply? Never mind your politics. Is it maybe a little bit of the America first? Do they think maybe, there's going to be some turmoil from this, but in the coming years, this might be the place to be. And then you look at REITs buying the rent shares. I think there's a lot of signs that this could be a remarkable opportunity to make acquisitions because you can get in while interest rates are a little higher. While there's some contrarian time to invest, you get in a lower basis. When you look at commercial real estate, I think it's mostly considered it's a long-term investment. It's not liquid, right? So if you're going to hold it long-term, you probably want to get in when you can get in at a lower basis because of higher interest rates, right? So that's something to consider because you're going to hold it long-term. I owned a little office building that I bought 27 years ago. It was the same environment, higher interest rates, a poor market. I took it to 3 of my top investors. They all passed. I bought it. And it really doesn't matter what the interest rates were then. It was a good location. So there's I think good opportunities for good properties. Heard this on I think it was on Twitter. This is not mine, but I like the thought behind it. Date the rate, marry the deal, right? So if you can get in better real estate and get in at a lower basis, you might not have I don't have the mortgage I had I don't have a mortgage that I had 27 years ago, right? So that's a little bit about the timing, and I'll leave it at that to leave any time for questions at the end or whenever.
Thank you, Michael. It's a great synopsis on where things have been, where things are now, current market and acquisition timing. I mean, I know you mentioned the conversions, Michael, from office. Is it office to co-working uses, self-storage? Are you seeing anything in particular there?
Yeah, I mean, we're seeing buildings converted to all kinds of uses, from torn down for new mixed use for new apartments. We're seeing converted to residential if it's the right building, the right floor plate, if it's got the right amenities around it. We're seeing mixed use development, mixed use in the buildings where it'd be multiple uses, including hotel and everything else. Jay, they've got a great one going on that's getting converted to hotel, and it's a beautiful building. It's well located. So there are more and more conversions. Sometimes it's hard to work that math out, but I think you're also getting more incentives from the cities, from the municipalities. They realize that they need housing, and maybe that's the way to do it, to give some tax incentives to folks. So we're seeing a little bit more of that in some markets. So I think we'll continue to see that. And I think when you think about the back to office that's happening, then I think that the existing office properties could be a good investment as well. Like we're selling some 100% occupied 10 and 14-year lease deals to credit state tenants at an 8 cap. I mean, those would have been 6 caps, in 2021. So if you can get in at a basis like that, and I think it's a pretty incredible time.
Thank you. And Alex, I know you're probably wanting to compound on some of what Michael has said right here. What is your investment thesis? What has gotten you into the conversion space and adaptive reuse? What are you seeing out there in relation to what Michael had just said?
Yeah, I think that what Michael's saying is exactly what I think about a lot, which is if you can buy something at the right basis, that corrects for a lot of other problems and that insulates you from a lot of risk going forward, right? And that's exactly what we're trying to do with what we are doing with distressed hotels. We can buy those at a basis that's maybe a third of what competing multifamily has. So that gives me all kinds of pricing power when it comes to being able to make sure that my units absorb and stay occupied. And it also means that I can offer an affordable housing. We call it a workforce housing product, right? Just to distinguish that we're not always trying to do capital A affordable housing. But when you buy in at the right basis, to Michael's point, then you can overlook, I don't want to say overlook, but you can just insulate yourself from a lot of different headwinds. And to Michael's point about you buy the asset, you date the rate, I think that that's exactly right. And if you're at the right basis and the right location, right, you're long-term oriented, I think that that's what really separates the sophisticated from the non-sophisticated investors, having that kind of time horizon. In terms of office specifically, I've looked at office conversions, just haven't found one that pencils for multifamily. And that's usually because the architecture of the building just doesn't work where the floor plates are really flat. There's not a lot of window space to floor space, if you will. You've got one place per floor where you've got a bathroom and you've got a lot of plumbing running to that space. So I know it can work. I haven't chased that a lot just because the market for hotel conversion right now is pretty inefficient and there's a lot of opportunities. So it's kind of like, why complicate it? But maybe in a few years when the low-hanging fruit has been picked, if you will, we'll shift over and look some more at office. But an 8 cap for stuff that is fully occupied on 14-year leases, that sounds compelling, Michael. You should send some of those listings my way. I'll take a look.
Thank you, Alex. And why don't you tell us a little bit while we're talking about the tokenization of commercial real estate? Can you summarize why people should get involved on the tokenization aspect right now?
Yeah, I will, and I'll be glad to. And let me just say that I'm like a traditional academic economist, and I've got kind of traditional views on investing. And maybe 9, 10 months ago, when I was recruited to start working on this tokenization effort, I thought like I did not want to be involved with anything that has got the word cryptocurrency associated with it. Like that's just like synonymous with at best speculation and at worst some kind of nonsense scam, you know? And I was like, we're not. So then I came to appreciate nobody is selling a token. No one's trying to get anyone to invest in a token. No one's minting a token or trying to like convince someone that that a token that they just created has value. That's not what's going on. So just how you might securitize a building, turn it into shares, tokenization is securitizing something, but digitally with smart contracts. And you should ask, well, why does a smart contract make something better? Yes, you'll hear that it can be done faster and maybe without as much of a legal bill, and you don't have to sign and countersign. They can self-execute, they're trustless, all this kind of stuff. But like fundamentally, how does that make real estate investing better? That was a question that I always had for people that were all fired up about tokenization. And let me just say that tokenization is also difficult to do legally because it's not like the bank likes that you take ownership and cut it up a bunch, across a bunch of new people, and that ownership is being traded on an exchange somewhere. So it's got to be structured in a way that's compliant. And here are the big benefits of tokenization, though. I'm convinced it does unlock real economic value, meaning it makes the underlying real estate more productive and more valuable. So in three big ways. Number one, when you tokenize a property, at least in the way that we're doing it, you can very easily attract international capital and you can attract retail international capital. So just imagine right now if somebody's got 20 grand, 50 grand, 100 grand in South Korea or Italy or Brazil, and they'd like to invest in the Marriott Courtyard in Atlanta. That's very difficult, if not impossible, for them to do, right? They got to get a US taxpayer number. They got to find a sponsor, vet a sponsor. Like there is a lot that's got to go on there logistically. Whereas if they want to invest in a tokenized property, all they need is an internet connection and they can invest. And so the transfer of funds and then the payment of dividends is seamless, it's frictionless, it's costless. So you think about what that does, equity being the most expensive part of the capital stack. If you can unlock an entire new market of equity providers, right, you can lower your cost of capital in a way that your competitors cannot. And that allows you to turn around and buy better quality assets, right? Squeeze more yield out of those assets, et cetera. So you're getting a whole new market of LPs, people that want to invest in something that's dollar backed and they want to invest in the United States. Tokenization makes that possible. Number two, tokenization makes a investment from the LP perspective, we'll talk about from the property owner perspective, highly liquid. So on our platform, for example, somebody can invest in a hotel. Let's say they invested $100,000. At any point in time, no questions asked, they can borrow 70% of that investment, right? And a third party will lend based on that. They could borrow 70%, they could turn around and invest in another hotel with us. They can actually turn around, then borrow 70%, reinvest again. They can do that 4 times. They call that looping your returns. Now, not everybody wants to pick up that much leverage, but you can imagine what that does to the returns if you want to pick up that much leverage. And of course, you could just pull that liquidity from your investment at any point. You couldn't do that in a traditional Reg D offering, at least not very easily. And then lastly, from the property owner's perspective, this allows them to access liquidity at any point, right? I mean, there's not really an equivalent product to a home equity line of credit for a large apartment complex or a hotel. Maybe you get a small business line of credit, but if you want to access serious liquidity, you got to go through a long and complex refinance process, or maybe you've got to have a really large, low leverage portfolio and you'll find somebody to help you access some liquidity. But here, with the tokenized structure, you can access liquidity instantly by tapping into an international network of investors. So the big benefit is liquidity, right? And that's fundamentally different than what a traditional securitized investment can currently offer.
Where is this marketplace found that people can go to access that, slice up an asset? Where do you get to that, Alex? Is that something that you're offering on your current investment portfolio, the conversions?
Yeah, so great question. So our platform, later this year, we will white label it for to other people that want to use the technology and the network to raise from an international audience. And we've got partnerships with Superstate, Wisdom Tree, right, large networks of registered investment advisors, both in the U.S. and abroad, that bring users onto the network. But right now it's our own properties, right? Properties that are wholly owned by us that we're tokenizing.
Derek, did you have a question? Derek Barker?
No, I was just saying, what is the name of you mentioned your platform? What is the name of your platform?
Yeah, Great X. It's an acronym for Global Return Earning Asset Token. I'll put a link in the chat.
Thank you. And Derek, why don't you move forward with your guys' investment thesis right now, what you're seeing in the market? If I'm not mistaken, you had been mostly concerned with the acquisition of value add multifamily. Can you tell us more about that and what Nectar is seeing in the marketplace?
Of course, yeah. So I can talk a little bit about what we provide, and I'll give you context on what we see in the marketplace and really why we position ourselves in this way. So, my background is in doing deep value add multifamily acquisition, rehab, and development. We've done some other asset classes, but that's largely what we were doing all through 2010, 11, 12, 13, all the way up until 2018, 19. And at one point, there was a huge spread, especially coming out of the great financial crisis. There's a huge spread between where you can buy something that's destabilized and needs work, and then where you can sell it on a cap rate. It's honestly, it reminds me of some of what's going on in the office market, where you can just buy things at such a low basis. But by the 2020s, by the time we got to that, the spread just shrank and shrank and shrank. People were buying things on pro forma cap rates that were really honestly value add deals. And so at the time, we decided that just wasn't a risk profile that we were looking to take, taking construction risk, developer risk, interest rate risk. When you buy, if you're the equity buying a acquisition rehab project, either you have to refinance it in 3 years or someone else has to get financing to buy it from you. So you just have an inherent refinance risk there. And that's why we started Nectar. In order to allow our investors and ourselves to be able to invest at a part of the capital stack where we can be behind, we're in second position and we're providing liquidity to people who have portfolios that are already stabilized, they're already cash flowing. Typically, these are properties that were bought, anywhere from 3 to 7 to sometimes 20 years ago. And people who own these portfolios, a lot of them are lower leverage because values have gone up by so much, because rents have gone up by so much. And not everyone, even if you bought at a high leverage in 2015, now here it is 2025, and you've been able to increase value a lot and increase rents. So a lot of the people in these with these portfolios, they have liquidity challenges. Assets are still, as Alex mentioned, these portfolios are illiquid. It's not easy to just get 70% leverage, frictionless and costless. So you have a lot of sponsors, especially these medium-sized sponsors, so $100 million, $150 million in assets, who are not able to access liquidity to buy assets, to reinvest in their portfolio, invest CapEx in their portfolio. We solve that problem by lending against their cash flowing assets. So Nectar is a lender to people who own medium-sized portfolios, lending against their cash flowing assets in the second position. So typically our deals will amortize down, so we don't have to refinance. We are shorter than the underlying mortgage. So, we don't have that refinance risk at all, and we're only going against stabilized cash flowing assets. So low leverage, the cash flowing. As Michael said earlier, the economy is fine. A lot of the assets are doing fine. The big risk in the market today is we go through periods where liquidity leaves the market. Right now, we're in a period where like banks have pulled back a lot. Things might be loosening up, but interest rates are higher, which means there's less capital availability. A lot of lenders that are in the space have made their requirements more stringent, and so there's not as much liquidity, and that hurts sponsors with high leverage a lot. A lot of sponsors that bought at the top, they have high leverage. They projected 3% rent growth into perpetuity and exit cap that was 100 basis points above where they bought it, and they bought it at 3.5, or 4. Like, so these people, a lack of liquidity, are going to hurt the most. But even people with stabilized and not highly leveraged assets, there's less liquidity for them as well. We provide that liquidity, by giving them a second, allowing them to get it fast, and so they can take advantage of this market. And what that means for us and for our investors is that we can get in. We're preferred equity, so we're senior to all the equity in these low leverage properties. We don't take any construction risk, any lease up risk, any interest rate risk because we're behind fixed rate debt, any refinance risk. Again, these are the real risks in the market because the market is mostly performing fine. There's still more demand for housing and demand for space, and there is supply in many of these markets. Supply has dropped a lot, so that's something that we expect to persist and even get more acute into the future. And we've taken a lot of the risk out of it, and by providing liquidity in a market where liquidity has dried up, we're able to create a lot of value and able to generate returns that are in the mid-teens to our, the mid to low teens to our underlying investors. We're able to clip a quarterly coupon, backed by low leverage cash flowing assets without having to take the big risks in the market, specifically construction risk, material risk, inflation, of construction cost risk, interest rate risk, because interest rates are quite volatile. The Fed is saying they might cut. However, we are in there's a chance that there will just generally be a lot of inflation. It's very difficult to cut rates into inflation. What we've seen in the past is even when central banks do cut rates, if there's inflation going on in the market, then interest rates can still go up. The Fed can cut rates on the front end, and interest rates, the actual real interest rates that people are paying in the market, can go up because people have lost faith in the dollar and in the fact that we will always have a deflationary environment or inflation under control. So anyway, I know that was a little bit of a ramble, but that's kind of what we're seeing in the market and how we're positioned to manage against the big risks in the market, which we see as really inflation, and also just generally construction in a time where materials are more expensive, labor is more scarce, and financing is more hard to come by.
Thank you, Derek. Well said. Let's hear from Jay Patel. How are the family offices and high net worth individuals allocating capital differently from institutions?
Well, as for us, we are direct investors. So we are not a fund with limited partners. With being private, we have a lot more flexibility. So for example, private equity funds will only leverage certain businesses 60 to 65% because they're in the business of putting out money. So writing a $35 million equity check north of 25 million, that's their sweet spot all day. We also have a lot more patience with our event horizons. Now, when I buy distressed mortgages, I'm pretty much in those for 12 to 18 months, restructure the note, maybe give a discounted payoff to the borrower and refinance. But we have a lot more latitude to kind of do what we want. We also have the ability to have a longer event horizon. So we're not constrained by returning capital to our limited partners within 3, 5, 7 years. It's impossible to time the market, even though you can get a sense of kind of where the macroeconomics are. But if the market's not going your way, hold on to it. Whereas we're not a forced seller, it's not going to be a fire sale. I think flexibility and the ability to be nimble. I've closed deals in 2 weeks, all cash, whereas a private equity firm would have to go to a capital committee and have a consensus and all of that stuff. So where we are allocating, because we focus on hospitality, we view that as really liquid collateral, meaning if I have to foreclose on a hotel or a mortgage, or if I want to sell, there's typically Indian American in that market that can take me out of my position, being that Indians own 60% of all the hotels in America. But outside of private equity, there's a lot of capital on the sidelines, and they aren't boots on the ground. They don't know where to deploy that. Whereas we're owner operators, we have a lot more access to deals. Now, they're household names, so everybody knows Blackstone, everybody knows Carlyle. Their reputation precedes themselves. It's family offices. A lot of people don't know who they are, and they're private generally for a reason, to stay under the radar. But as far as capital allocation, where, I guess to a prior panelist point, we're in a weird macroeconomic environment, right? Inflation's at 2.9%. It should be 2%. Anything more than that, growing in perpetuity, you're larger than the US government. So inflation should be lower at 2%. Unemployment, is pretty much below its norms at around 4.2% when it should be 5.5%. So the job market's really strong. Inflation typically is inversely related to unemployment, meaning inflation mathematically is wages divided by prices. So you've seen a lot of inflation with respect to consumer and household goods. Groceries have gone up, utilities have gone up, property taxes have gone up, insurance has gone up, but wages haven't kept pace with that. And so it's really interesting to see where the rubber band stretches, right? The US consumer is 2/3 of the economy, but that rubber band hasn't busted yet. So, a lot of people are being patient on where to deploy, but a lot of people have been saying that for years, right? That crash hasn't come. So there's people on the sidelines, but there's people like me that are building. To Michael Bull's comment, yeah, it takes 12 to 18 months. And in that period of time, a lot's going to change. We're going to be in a better market. All this noise with tariffs, yeah, it may affect construction costs, but you also got to think about it. We're in the US, we're a net importer. We import oil and gas, and we send our petrodollars to the Middle East. We import goods. We send our discretionary income to China. So how do you fund that? Well, treasuries, and China's the biggest owner of treasuries. So there has to be a shakeup in the status quo. And we believe that in 12 to 18 months, the market will normalize because something has to give. On the new construction site, we're building, meaning if you can make a project feasible at prime plus 1, 8.5%, 9%, it'll cash flow even more when rates go down. So, I look at it that you either have higher rates or you have higher construction costs. Materials, they're linked to commodities. Yeah, that price is typically going to go up, and it's linked to inflation. What we've seen is a decrease in labor costs, meaning in this market, who's building? Well, I am, but not many people are. So contractors and subcontractors are desperate for work. You can tell them you can get on the job in a month and they'll renegotiate. And I'll give you an example. So I'm building the Candlewood Suites block and plank in Oakwood, Georgia. And initially I had a AIA contract with my general contractor for framing, steel framing. In the guaranteed maximum price contract, that was priced at $1.7 million, and that worked. Well, I've renegotiated it with subcontractors for $850,000, right? I'm saving $900,000 just because people are desperate for work. So It depends which bullet you bite, but if you can make projects pencil at today's cost of capital, you'll only be in a better place when rates go down. Now, historically, if you look at interest rates, they've typically hovered around 7 to 8%. So we are not in that age of free money anymore. And we'll see what gives. You know, the Fed kept rates steady just most recently because they're not going to drop rates. That's only going to create more inflation. They've got to take money out of the money supply system, and that's reducing their balance sheet, selling bonds and taking that cash out of the system, hence making money more scarce and rates going up. So, you know, long story short, I build, you know, consumers gravitate to the newest product in hotels. Would you rather stay in a new hotel or an old hotel? Well, generally a new hotel. So we are big believers in new construction. We think the market is under demolished, not overbuilt. And, you know, we take that approach. And I'll give you just the last example. There's a big public bank that lends me money on my Candlewood Suites. They lent me 65% loan to cost because on the pro forma, that equated to a 1.7 debt service coverage ratio. Well, the same lender 2 years ago underwrote a 1.7 debt service coverage ratio at a 5% debt constant. Well, now that debt service coverage ratio is 0.9. It's barely servicing its debt. So a lot of lenders have distressed debt on their balance sheet. They haven't cleaned up, and the big banks can stomach it. They can write down their capital. They have enough tier one capital to absorb it. What has not happened, and what's really surprised me, is community bank failures. I haven't seen a lot of bank failures. I guess maybe the regulators are taking it easy on them, but they've got to mark to market their loan portfolio, and I just really haven't seen that, if that makes sense, Chris.
Yeah, Jay, you know, how can investors distinguish between a temporarily discounted asset and a distressed one, perhaps with deeper structural issues?
Yeah, I mean, so distress takes a couple of things. When I buy mortgage loans, first mortgage loans on hotels, you get a couple of defaults. You've got a maturity default where the owner can't refinance. You've got a technical default where the borrower breaches covenants such as debt service coverage ratios or something along those lines. And you've got monetary defaults where they simply can't pay their mortgage. Now, banks, after 90 days past due with FASB impairment testing, they're required to write down that asset. So there are 3 different types of defaults, and you've got to understand what you're getting into. Now, if there's a monetary default, it's probably indicative that the borrower is simply over leveraged. The cash flow is not there to support the debt, and you have to have a deleveraging of the asset with more equity, right? Technical defaults, those could run the gamut on what the borrower is in breach of the loan covenants, and maturity defaults, which I think, as people alluded to in the CMBS market, you've got $1 trillion of fixed rate debt coming due. Well, those borrowers have to refinance, and if they, you know, if they get fixed rate debt, rates are higher. If they get floating rate debt, rates are even more higher. So they can't service their first mortgage, and they can't take mezzanine capital because they can't service the mortgage, the first. So they've got to take equity and deleverage that asset. And we're waiting for that shoe to drop as debt comes due. On the CMBS, the non-recourse servicers, you've seen an uptick in delinquencies and defaults. I think about 13 or 14% of all CMBS hotel loans are in default. So that's like 1 out of 10 or 1 out of every 9. But servicers in that industry, they're in a fee-based model, right? They want to milk the asset at the expense of bondholders and just create their fees. So when they liquidate those assets, we'll see. But I'm looking at some of the big lenders that are selling portfolios, and there's some in the market we're looking at. But it's really surprised me that we haven't had more bank failures, because I know they have exposure on their balance sheet, but the rubber band hasn't popped. So on the distress side, look for three types of distress, but I think what people should look for as the low-hanging fruit are the maturity defaults, where you can come into an asset, recapitalize, maybe dilute the owner down because you're bringing in fresh equity, or just buy the mortgage and restructure or foreclose. And if you buy the debt at a discount, you've blown out the equity, and you're in at a great basis. The only thing that could prime you is property taxes, which you do a title search and you can easily figure that one out.
Great answer, Jay. Does any panelist have anything to piggyback on that before we move on to our next question?
I would just say that we're seeing a lot of the exact same thing in the market, and that's where a lot of our deal flow is coming as well. There are just a good number of people who are participating in the market in 2021 and 2022 who just have assets that are underwater, and we see that a good bit. I will say though that there are who owns these assets makes a difference. A lot of people are good sponsors who have, a couple of dozen properties, and they have 2 or 3 assets that are really in trouble. Or maybe they have, 10 assets and they have 3 or 4 that are in trouble. Okay. So like, it's not, sometimes some people, they're varying degrees. And so you can find tremendous deals if you come up with creative solutions to either help the lender in that situation by allowing the lender to be properly capitalized and right sized, or help the sponsor. And so Jay and I think are just coming at this exact same market realities just from different angles, in that we're seeing a lot of the deals that we get, there's a distressed underwater deal. Hey, can you bring equity into this deal? And we say, no, we're not going to take construction risk. We're not taking that refi risk a year from now, or like right now, you're in technical default. You need equity. However, you have this beautiful 50% LTV property that you bought a few years, and we can come in and partner with you on that asset, bring capital to that asset that you can use to bring equity to another part of your portfolio. And we're seeing a ton of that in the market.
And
yeah, Derek, oh, go ahead, Michael.
Yeah, I'd add as some examples. The $12 million office 17-story deal, that loan was 26 million, I think, that we're out at 12 million. We also are doing a lot of other short sales. So that's a lender that chose to let the borrower do the sale and accept whatever the net is. We also have Class B and C apartment communities around Atlanta, the same situation that we just brought out to market. And then in Jay's world, this is probably not nice enough, but a very large, completely vacant hotel, the lender did take back. So we're seeing lenders take back some, and then that we're taking to market, and then sometimes they're letting the borrower do it, so they're not in the chain of title and those additional costs. So there are some opportunities, and it's kind of amazing. You see the distressed stuff, and then you see a lot of very core, very nice properties that in some cases you can get a good price on just because of the high interest rates and also potential of lack of new supply impacting future rents.
Great discussion, guys. And I want to return back to Derek really quick with, volatility and pricing. How do you build conviction in your acquisition decisions?
Volatility in pricing, like asset pricing?
Yeah.
Okay. I mean, so we're coming in a preferred position. Typically, we're in a second position. Typically, we're coming into existing assets that are already stabilized and cash flowing with in-place debt that's fixed rate. So we get conviction by looking at existing trades and assuming that things aren't getting better. So it might be a little bit different from a lot of people. We look at, hey, prices are 110 a unit and 6.5 cap in the past 3 deals that traded in the market. I'm going to assume that is, over this next 5 years, they're not getting any better than that. As a matter of fact, how do we look if there's 10% revenue declines, and if cap rates expand 150 and 200 basis points? So these are our base level assumptions based off just kind of, because there is a scenario where things get better, where rates go down, but there's just a reasonable there's the probability of much higher interest rates and much higher inflation, it's just not zero. And I think that in the marketplace, it's probably under valued. But here in the United States, we had 17% rates. There's nothing to say. There's no rule and there's no economic law given down by the economic gods that rates are going to be in single digits. So we're creating a structure to be prepared for that. And in this environment where there is this uncertainty, because maybe rates go back to 4%, maybe they stay around here, who knows? But in this environment of uncertainty, cash flow matters. And back to basis. Basis solves so many things. If you're in a basis where you're cash flowing, where more money is coming in than is going out after paying just the reasonable fixed locked in rates that you can get, then you'll probably be fine because because you're at a base where you can withstand price volatility. So to answer your question more succinctly, we get comfortable around price volatility by looking at cash flow. And if it doesn't cash flow, then there is just no story that will convince us. We're not pro forma type people. We're like, cash flow type people. And if you can get something that cash flows in this environment, if there's inflation, then more than likely you're going to be able to push rents. And that's kind of how we look at it.
That makes good sense. How would you say that the GP/LP expectations are evolving in structure and return profiles?
Evolve. Okay, so you're taking different risks as a GP or an LP. So sorry, but am I answering the right question? By looking at investing alongside the GP versus investing as an LP in a fund. Sorry, can you
Yeah,
clarify?
and how it's changed over time with how you guys are seeing it.
Yeah, when we first came into the market, we were doing a lot of, there's just a very typical structure. You get paid an acquisition fee, and then you get paid, you pay a pref. At the time we were getting in, it was 8. Some people got better, all right. I'm sure, or some people like Jay they've never paid a pref because they have their own money, But and then after that, there's 80/20 or 75/25 structure. We've had in environments where it was less LP friendly, all of the deals have their own promote. So if you really knock a home run out of the park, then you get a different promote and than there. So that there's but in more LP friendly environments, you have the entire fund that performs as a promote. I'd say that yeah. Uh, what I've seen is that, and this might be just talking my own book because there are a lot of LPs out there, but our LPs, and part of the reason why we got out of the multifamily space, they were looking for cash flow. The idea of buying something and then just hoping that in 2 years after doing a renovation, you're just able to sell it at a higher basis and never get cash flow and have them never get cash flow, but they're going to just sell it along higher. We were in that type of environment for a little while, and that was okay. What we were hearing at the time, and this is 2019 and 2020, from our LPs, is that, hey, we want to see something that's cash flows, and I've seen that just get more and more important. Where you stand out in the market, in a market like this, where there's uncertainty about what the future looks like, by just you have checks today, you have real cash flows today, and checks can go out every quarter today. I think and we've created diversification to make sure that we might have home runs, we might not, but the cash flow is going to be able to remain the same. We're going to be able to pay quarterly distributions, and LPs have been incredibly attracted to that.
Great answer, Derek. Thank you so much. We're going to change gears just a little bit, maybe take another question before we hear from the audience questions that have been fielded. Actually, to Alex Cartwright, what role would you say that AI and predictive analytics are playing in market timing and due diligence today?
Yeah, that's a good question. And I am not using any of those tools for due diligence or underwriting, right? And like, I'm not an expert on this, so maybe I should comment less, but if you understand how an LLM works, right? LLM is not like a more advanced type of Excel. Like fundamentally, it's pattern recognition. So it's not good at stuff like math. Like when you ask Excel, what's 1 + 1, it's doing a computation. An LLM doesn't do computation like that, right? So that combined with underwriting, like maybe there's some use cases, but we're not using any of that right now for underwriting or due diligence.
Derek, anything you guys are using in that space?
Yeah, and I'll be sensitive to the time, so other panelists, but we use AI very in every single part of our business. We have AI implemented really at the core in our back office systems, in the front end of the marketing, our entire underwriting process. We have a portal where people put docs in. We have specific AI agents that are specifically trained with our SOPs, with our universe of documents, and not, let's say, poisoned. That might be too strong a word, by what else is going on the internet. But we are training our own AI agents to look at docs in a certain way, pull out information in a certain way, put it into our system in a certain way. We have other agents that take that and convert it into a memo that we look at. We have agents that check the work of the other agents. In marketing, there are different things that you can do. AI is not like humans. I say they have their own issues where they act up and they don't do what you want them to do. However, what we found is that AI is just incredibly faster than humans and makes mistakes that are predictable in a way that humans' mistakes are a little bit less predictable, although humans are pretty predictable too. And that if you have systems where you can treat them like you would treat an employee, onboard them, manage them, correct them when they're wrong, and you lean into it, it can transform what is possible. And I believe that it will transform the real estate capital markets in such that it will be able to be more liquid as more people catch on to these tools. Because the large banks, capital couldn't flow to $100,000 checks and $1 million checks, $1 million equity. And the institutions don't write $1 million equity checks. That will be possible in the age of AI. Being able to close real estate transactions in one day, that will be possible in the age of AI and in blockchain. I know that it will be because we are pushing to make that stuff happen. And the technology is pretty close to being there.
That's exciting. Anybody on the panel have anything to add before we hear from some audience questions?
Well, I was asked, this is Michael, I was asked the other day on stage if I've used artificial intelligence, and you know what, I tell you, I've been using it for 35 years. That's all I have is artificial intelligence.
I like that. Jay, do you have anything to add?
Yeah, so we're not using in our underwriting because I view that as a manual process, but what we are using it in is operations within our hotels. So for example, my father went to the Four Seasons in Palo Alto and he had Grey Goose. Well, he went to the Four Seasons in Bombay and they didn't have Grey Goose, but they already knew. They apologized. So anticipating the needs of the customer. But also our security. There's a system that I was just floored by last week. It's called Verkada, Smart Camera Security in your hotel. It actually links, like I saw an example, it linked a list of sex offenders within the surrounding 10 miles. And as soon as they walk into your hotel, it already has facial recognition that puts them on alert, or guests that do not rent because they may have trashed your room. So I'm seeing our AI in the operational side, but definitely not in the underwriting. What I do see AI removing is transactional attorneys, people that close deals, very cookie cutter stuff, not litigator attorneys, but transactional stuff where you can automate that process and it'll be more efficient. Like even with DFX, they're getting rid of the middleman. So lenders will still have a place to coexist, but financing brokers, this could put them out of business, right? And so it'll be a big change for the industry as it gets adopted.
Thank you guys. Really great points there. And Jesse, Kat, would any of you guys like to read out some of the questions from the audience? I haven't been monitoring the chat.
Yeah, absolutely. Oh, all right. Yes, we actually, somebody reached out to me individually, said, what single policy change, for example, zoning, tax incentives, would most accelerate innovation in real asset investing? And this is a question for all, so anybody can jump in here.
So on the hotel side, we've seen what was really beneficial to us during Trump's first term was accelerated depreciation. I could buy an asset, write off all of the prior furniture, fixtures, equipment, have huge carry forward net operating loss, and don't pay taxes going forward, and keep doing that, buying another building and buying another building. So tax code reform, we'll see where that gets us. But these opportunity zones, I don't invest in those, because there's a reason why that market needs capital going in, and I don't think it's the first mover advantage, right? You're taking a long play on that, and why reinvest your capital gains in that when you could 1031 into something else? But I think tax reform will be the biggest boom to.
Great,
Anybody
thank
else
you.
on that?
Well, I would just add that, I think when interest rates if they start bumping down again, that'll be the catalyst to people that, all right, well, maybe we are at the bottom, maybe it is time to invest. So, and we saw a little bit of that, at the end of last year, and I think that'll pick up activity a little bit as well.
Thank you, Michael.
Yeah, I have also one specific question to Michael Bull. What under the radar markets are outperforming commercial acquisitions today?
I think there's opportunity really in every sector, depending on your view and your mission. We just priced out a Class A apartment deal of 289 units in a mixed use environment, and recent comps at 5% cap rates, when, they're probably financing some of that, at a higher rate. And they're banking on the rents escalating because of lack of new supply. So I think there's opportunities really everywhere, depending on the sub-market and market. I think if you're a opportunistic investor, and you're not in the realm of buying, notes and that sort of thing, which is, way more involved, and you're just looking at ongoing real estate, then the sector that I think has the most promise right now, opportunistic wise, is office. I think there's a lot of reasons that demand comes back faster than we think. We've had positive absorption for 4 years, leasing activities up, supplies down, and the companies are realizing that there's about 15 one-word reasons why companies want their people back for the most part. So I think that's the opportunity right now.
Michael, are you guys? Oh, go ahead, Jay.
Sorry, I was just going to throw in quick 2 cents. Where we like doing business and we see the most yield is in suburban markets versus central business district markets, primary. So there's suburbs in Atlanta where I can get the same rate ADR as I could in downtown, but I have lower operating costs, meaning I'll have lower payroll, utilities, taxes, insurance. So I'll actually have more cash flow doing business in the suburbs than I would in a central business district downtown. So when you're chasing yield, look for, secondary and maybe tertiary markets, but you also don't want to be kind of the only game in town. So secondary markets are where we're seeing the best opportunity.
Yeah, it's a good point. I was going to ask Michael in pertaining to the question about some of the assets that might be under the radar. Michael, do any of your people specialize in iOS, industrial outdoor storage, or maybe even in the mobile home type of parks and RV storage and stuff like that? Or are they seeing a big uptick in how that's institutionalizing?
Yeah, we have weird agents too, as normal agents.
Yeah.
No, I'm kidding. Yeah, I mean, we have a self-storage broker who has a deal out right now that's self-storage and mobile homes. We have an industrial sector that's doing the parking deals. So, yeah, I mean, those are niches that, if you understand them, can be great to get into.
Yeah. Kat, anything else from the audience?
Yes, I have one more question for Alexander. So beyond hotels, what overlooked asset types examples like malls, offices have high conversion potential to multifamily.
Yeah, malls I've seen, the right layout mall, and office, like I mentioned, is difficult in most circumstances. I think behind hotel, it's got to be senior living, just because those are also in high quality locations that are pretty residential. And senior living is, it's set up where you've got the bathroom and every room in most cases. It's also set up with a lot of electrical capacity going to different rooms to run, medical equipment that's electricity intensive. And so that capacity is helpful when you're looking at adding a kitchen if they don't have kitchens already. Plus, I think that a lot of these senior living facilities, they become kind of architecturally obsolete in that there's some kind of code change that makes it too expensive for them to comply with, or they lose a state license, and then they just kind of sit and wither away. So those can be purchased at an attractive basis and converted.
I'd agree with that. We're seeing that. We've been selling several senior housing properties that were not very old, I mean 2 or 3 years old, that were shut down and empty. Some cases are going back to senior. But as far as changing use, we're seeing some of those change to drug rehab, where your monthly rents are 2 or 3 times what they were for senior. So that's an opportunity. Ernie Anaya in our shop leads that group, and there's been a tremendous amount of increase in transaction volume in senior housing, and I think some of it is because of the lack of transactions during COVID, but also the demographics that maybe we're 10, 15 years out from the baby boomers really starting to create more demand. But a lot of these conversions, as you're saying, I think are real opportunities for folks. There's a big business aspect to it, like Jay's Hotels. It's not just real estate, but it's a nice sector.
Yeah, on the conversion side, we've taken 2 office buildings to hotel. You can't take hotel to office buildings based on the structural load, but you also got to look at the floor plate, meaning the narrower the building, the better, because if you have a large core in your floor plate, you're going to have a lot of dead space, wide hallways, or you can only put so many hotel rooms because each hotel has to have a window. So we've taken office to hotel, and then we haven't done hotel to multifamily, but in that business, you really need to buy an extended stay hotel that already has the mechanical, electrical, plumbing there. Otherwise, when you start taking down sheetrock and joining rooms, it's very, very expensive. And you've got to look at your rental factor per square foot in the market to make sense of it. In those cases, you almost have to get the building for free, for pennies on the dollar. But if you're buying a old residence inn, extended stay hotel, those work great to convert to multifamily.
Thank you guys so much. Kat, if we don't have anything else, maybe you guys would like to conclude, and thank you guys so much. Thank you all the panelists. Thank you for everybody in the audience for joining us today. We'll send out some recordings and clips for all of you. Jesse, Kat, do you have anything to close us out and tell people how to maybe get more involved in DFX in the future?
Yeah. I want to thank Jay, thank Michael, Alex, Derek. That was phenomenal. Chris, as always, great job. Now I know that you can moderate these things. I'm going to be calling on you a lot.
Oh, no.
So DFX, definitely get involved. So join dfx.com. You can list your opportunities. You can use promo code SUMMIT, SUMMIT. You get a free month. As mentioned earlier, we don't charge any transactional fees. It's essentially a global capital network. It's tech enabled. We host things like this. We host networking power hours every week or two to get everybody together and start to build these relationships. The network's grown significantly. We continue to grow every day. So we'd love to have all of you involved in the future. And we also are bringing on community leaders. So if you have any expertise in your local community and a good network, would love to have you as part of our network as well. And we can support you, you can support us. It works very well in that capacity. We build a lot of partnerships as a company. It's very much partnership and collaborative focused. We're really looking to bring everybody together in the deal space into a much more cohesive, functioning ecosystem than what is the current status quo. So a lot of exciting things coming up as a company. We have our 2.0 version releasing later this year. That's going to be an absolute game changer for private capital. If you're not on 1.0, you certainly will be on 2.0, but I would recommend getting involved earlier than later. And then tomorrow we have the day 2 of this conference. You can register through Luma. That is more venture and angel focused. Have some just extremely high quality groups on those panels, just like today. I mean, these panels, both of the panels today were incredibly impressive. We got just some phenomenal content. Our marketing team is going to go to work on that. We'll make sure that a lot of these recordings are accessible, and we'll be putting together infographics on everything that we learned as a company through these panelists. And just want to thank you all for staying this whole time. It's a great turnout. And again, tomorrow is another day, and it'll be a different kind of vertical, but it'll be very informative and a lot of great thought leadership. So thank you all, and looking forward to getting you more and more involved in our ecosystem.
Take care.
Thank you, everybody.
Thank you.
Thanks so much, guys.